All right. Can everybody hear me? Amazing. I have lots of friends clearly in the audience. That's amazing. Well, welcome to the 7th annual Afore Pre-Seed Summit. In the world of AI workers, it's nice to see a lot of humans in the same room. Enjoy it while you can. Who knows, maybe in the future our AI agents will be going to these summits. It sounds kind of sad, but maybe it is the future. Anyway, excited to see you all here today. My name is Gaurav Jain. I'm one of the founders of Afore Capital.
I'm Mehta, the other co-founder.
We started the Pre-Seed Summit 7 years ago to put a spotlight on this new stage called Pre-Seed. Back when we started, Pre-Seed wasn't very well known. We thought, what a great way to put some spotlight on it and start this summit and invite interesting speakers to come talk about their early days of building a company. Of course, 7 years later, Pre-Seed is not as unknown as it was back in the day, but it's become a bit of a tradition for the fund to do this summit every year. So we've continued to do so, and hopefully we'll do it many more years in the future. We've got an amazing lineup today. We've got 3 founders who started their companies as an idea and took it public eventually. Obviously the dream for a lot of us here. They'll share their journeys of what it was like in the early days, going from 0 to 1, getting to product market fit and then beyond. But before we do so, let me take you a little bit into what's happening in Pre-Seed. We'll talk about the macro and what we are seeing in the portfolio. The chart here, you can see, hopefully I'm not getting in the way here, maybe I'll stand on the side a little bit. You'll see the slide here, on 2016 is when Afore started. And in 7 years or so, we've charted kind of number of pre-seed rounds per year versus seed rounds. As you can see, the number of pre-seed rounds per year has gone from 10% of seed to about 58% of seed. And this is an interesting chart because when we started Afore, one of the biggest pushbacks we used to get was that it's a fad. This pre-seed stage is going to go away. It's just a time in the moment, and clearly the chart here demonstrates that it's here to stay. And as you can see, it continues to grow steadily over the last few years. But obviously, it's gotten to a place where it's more than half of seed. One of the other pushbacks we used to get when we started Afore was that pre-seed is a negative term. It was reserved for founders that couldn't raise a seed round, and hence had to raise a pre-seed. But Mehta and I saw something where we believed that if we backed these founders early on, before they had traction, before they had product market fit, that these could be wonderful companies. And 8 years later, we're seeing that in the portfolio. So we expect this trend to continue over time.
And in fact, if you look at the data from 2021 to 2022 to 2023, pre-seed is the only category that has grown relative to even seed and certainly for later stage rounds, which have declined over time. What this tells us is that pre-seed is not only a mainstay in the way founders start their journey. That's the very first round that they raise is called a pre-seed. It might appear to be optics, but to many founders, it is the way they raise. And if that's what they're raising, then that's what VCs are investing in. And as a result, it's not just Afore that invests and leads pre-seed rounds, but it's seed funds, Series A funds. Most funds are now investing in pre-seed, which helps us sort of establish the category. And you'd notice that this conference itself is not called the Afore Capital Conference. It's the Pre-Seed Conference. It's a celebration of all founders who are just getting started.
So the question we asked ourselves is, why did this term, that was a pretty negative term 8 years ago, why did it resonate with founders? And I think there's really 5 key reasons for that. The first is it's the right amount of capital. So the way we define pre-seed is typically rounds of $500,000 to $2 million. We think this is the right amount of capital that the founders need to get to product market fit. And again, we're kind of constricting this to mostly software companies. Less than 500K means you're raising money every few months. And that's not a lot of fun. I've been a venture-backed founder. The last thing you want to do is waste time with VCs raising money every few months. You want to be spending time with customers. And more than $2 million, sometimes certainly more than $3 million, means too much capital. You might lose focus on what is important. And we think constraints breed creativity. So that number of $500,000 to $2 million is the right sweet spot. The second thing is the right price. A lot of times founders would go to an accelerator, give up 10% of the company and then having to raise a demo day, and they end up selling, half the company in some cases before the Series A. But what pre-seed allows you to do, because you raise a relatively small amount of capital, is manage your dilution, because you're going to end up raising multiple rounds of funding before you get to, the promised land of a public company. It also sets the right expectations on the founders and the team, right? The early days should be all about experimentation and trying a lot of different things, moving fast. And if you raise a lot of capital or call it a Series A or even a seed, it puts an expectation that you have more things figured out than you actually do, right? So I think it behooves you in the early days to set the expectations too high on yourself or the company. It also has the right optics because it gives you the optionality to then raise a seed or a Series A after the pre-seed round, versus if you raise a seed, the next round kind of has to be a Series A and so on and so forth. So founders really like calling their first round pre-seed for that reason. And finally, it's also the right incentives, right? When you raise a small round from a big fund, it's largely a call option for them. But what we hear from founders is when they start a company, it's not a call option, right? They're all in. They've quit their job, they've bet the farm, they want to build this company, and they want their investors to also be all in with them. And as you can see, in the year of the Olympics, we have the 5 rings. We had to. But these are, we believe, the key reasons, at least what we hear from founders, why when 8 years ago, founders were typically not calling their rounds the first round pre-seed. Today, we hear vast majority of them calling their first round pre-seed.
What's really interesting about the Afore portfolio is AI has taken off amongst pre-seeds also. So what we decided to do across our 150 companies or so is just to slice them by companies that are AI and companies that are non-AI. And all pre-seeds. One of the things that we find is that the companies that are AI only, are natively AI, kind of get to $1 million in revenue within 12 months or so after starting. Typically, that is a non-AI company. It's taken them twice as long to get to $1 million or so in revenue. The other really interesting thing that we find, if we slice the data this way, is that it takes a company to get to $1 million. They've only burned just north of $1 million, $1.5 million for about AI companies. So the burn is much lower, about 5x lower than the burn for a non-AI company. Typically takes north of $7.5 million or so to still achieve the $1 million. One of the reasons, obviously, is that a lot of AI companies don't need to, after they raise a pre-seed, don't need to hire as many people because a lot of the code can be written, at least 30-40% of the code can be written by a machine and not necessarily a human, allows them to preserve burn for much, much longer. A really fascinating insight from our portfolio over the last sort of 7-8 years or so.
I mean, this will also have an interesting implication in venture capital as a whole. Right, we expect this to make pre-seed even more attractive. If founders can get more done with less capital, they probably will end up raising smaller rounds of capital, right? Because they can run more experiments, they can build more product, get to more revenue faster. And what we think may happen is founders raise, let's say, $1.5–2 million up front to be able to quit their job, get the initial product in the market, get some revenue, get to product market fit, and then raise a big round of funding to really own the category, because distribution is still expensive, but you can delay when you raise the next round of funding. And we think there might be more of a bifurcation in venture capital if this trend continues.
Our 4 companies are very well known for raising a very small amount of initial capital, $1 million, $1.5 million, and from there, raising an insane Series A. So typically, our companies go from about $1 million round to about a $10 million round in about 12 to 18 months. About 64% of them do that. And that'll probably be accelerated even more with sort of benefits of AI. And now, I want to introduce the team slide because we really had to update Gaurav's image just a few weeks ago.
For folks who know, you know if you know.
Like the old team slide had him with hair. This one, over the summer, things have changed. So
it's the stress, guys. I'm telling you.
It's like we're finally over that, so we had to update the photo. And I want to shout out to the rest of the team: Derek, Joe, who'd recently joined us, Kayla, who's helping put all of this together, Jack, who's also helping Kayla. I don't know if you're out here or if you're in the back, and Jared, who just joined us recently from Correlation. So shout out to the team. Please do say hi to them. There's no other staff helping out with this conference except for us and Crystal downstairs. So shout out to the team and the founders who are helping out today.
Well, a round of applause. All right.
And then one other thing that we wanted to plug is what can come before pre-seed? Any guesses? We thought about calling it pre-seed, but that would be too much, so we came up with a different name. We called it Founder in Residence. Over the last 2 years, one of the things we found is many founders would come up to us and we would want to invest about $1 million, but it turns out that money is not necessarily what they need. What they need is help in getting them to conviction on their idea. They're probably several pivots away from the right idea, and they need help with talking to customers, talking to advisors, talking to users, and they actually need to work together. So we pulled together 5 or 7 folks, one cohort at a time, where we could spend quite a bit of time with them. It's sort of like, as founding product managers at Twitter and Android, allows us to sort of go back to our invention days one more time. So we started doing that last year. It's a play on the word entrepreneur in residence, which is usually a solitary experience that some folks, operators, go through in venture funds. So we pull together about 5 to 10 founders at a time and really work with them over 2 to 3 months to get them to conviction on their idea. Usually these are smaller checks. Usually these are pre-idea folks. Usually people are trying to get to the right idea over that period of time. Some of them make it, and some of them don't. But that's something that we've been doubling down on over the course of the last sort of year and a half. And now we're in our 5th cohort. Many of them are right here in the front seat, actually. And we're really excited about what this holds. So if you know of anyone who is pre-idea, kind of thinking about something, doesn't want an assembly line experience, is not looking at a demo day, but really wants to have conviction on what they're building, please guide them our way.
We literally put our email address for Jack there, so if you know anybody, just send us an email directly. All right, well, with that, let's get the show on the road. We've got an excellent lineup of speakers today. As I mentioned, we're humbled to have 3 founders who've literally taken their companies from idea to IPO speaking today. We're going to kick off with Apoorva from Instacart. Then we've got Frederic, who started Okta, and then Aaron Levie, who started Box. And then we're also going to hear from a bunch of investors that can share their perspective of what they're looking for in companies. And we chose a diverse set of investors who invest in everything from pre-seed to growth from different funds. So hopefully we'll hear a pretty diverse set of opinions. And then we'll leave time for networking at the end. At 5:30 to 7, there'll be drinks and hors d'oeuvres. The one thing, if you can ask, is while the sessions are going on, if you could just stay in this auditorium, and then that's why we have the happy hour at the end. Otherwise, it becomes quite disruptive in the conversation. So if you can stay in the room, that'd be amazing. We'll also have Slido QR codes on the side screens when they go up when the sessions are going on. So if you have questions, feel free to scan the QR code, put in your questions, and then the moderators will just monitor the questions that are coming in, and we'll pick up the questions as it makes sense. Amazing. With that, let's get started. And guys, there's some seats in the front if you'd like to come in and sit down. Welcome to do so. Awesome. Thanks, guys.
Thank you.
Okay, can you guys hear me? Awesome. Apoorva, I was thinking of introducing you, but then I thought maybe I'll just ask the audience to see if they know you. How many of you have used Instacart in the past? Okay, there's some people that were born after COVID, so they haven't tried Instacart yet, but they'll get to it.
Meet me after for a coupon code.
Do you still get coupon codes after you left? Yeah?
You like some too?
Yeah, I would love that. I'm a cheap Indian, so I'm always looking for deals. Awesome. So let's get started. You need no introduction, so I'm going to cut right to the chase. Instacart was your 21st company? Did I hear you had 20 failed startups before you started Instacart? You have Indian immigrant parents like I do. You went to Waterloo Engineering like I did. Did your parents not call you at any point and be like, son, we love you, but you need to get a job at Google? Like, what is wrong with you? We did not come to this country so you can have failed startup one after the other. Tell me more about what kind of kept you going. How did you end up starting Instacart?
You know, you'd be surprised that still happens, by the way. I believe that perseverance is the most important quality in a founder. And that means that you have to go from a setback to another setback without losing motivation, without losing the optimism that the next one is going to be the one that works. And while, on the one hand, you can say that those 20 different companies that failed were failures, and they were, but I learned a lot, right? I learned how to move much faster. I learned how to raise money. I learned how to pick better ideas, and that led me to Instacart. And so, I think that, not all failure is catastrophic, and you got to keep going.
Did you ever doubt yourself in any of those companies that maybe I'm not cut out for this, or did you just have this maniacal belief that you're going to make it happen?
I think it just comes back to the perseverance. I mean, I remember, look, like I don't want to sugarcoat it. It really sucked. It really sucked to go from one failure to another. And what ends up happening when you come up with a new idea, right? And you feel like that's going to be the one. You have to get emotionally invested in that idea, right? You have to get emotionally invested so that you can really not only convince yourself, but you can sell others to join that idea. And of course, you do that, and then you realize that, in fact, for a multitude of reasons, it wasn't a good idea. It sucks, right? There's no way to sugarcoat it. But the reality is that, you see all these founders, and you see outside looking in, there's just like, you just see them as these success stories. But every single day, they're going through so much failure. Every single day, they're going through, so many setbacks. And, persevering through that is, in my opinion, what makes a great founder.
Instacart started at a time when delivery startups were failing left, right, and center, right? There were a lot of them. Uber for X was very much a thing, but most of them were not working out, unit economics, so on and so forth. When you described the concept of Instacart to your friends, did they ever respond with Instacart, so like webvan, but not... How did you have confidence that this will work? Like, did you ever doubt yourself? How did you test the hypothesis? How did you know this was it?
I think this goes back to the last question. For me, Instacart was never a hypothesis. It was not an experiment. It was going to work. It was just a matter of how. And we were just going to figure out how we're going to make it work. And yes, of course, there's a lot of people pushing back on us and saying, why isn't this another webvan? And webvan, for those of you who don't remember this, it was like this multi-billion-dollar, one of the biggest .com, failures. And so of course, that was the biggest question on Instacart. For the first 5-6 years in the Instacart journey, that was the question. And I remember going to a VC meeting, and midway to the VC meeting, right? The VC just, walks out of the conference room, right? I was like,
did I miss something?
And then he comes back in a couple of minutes, right? And then he slams this floppy disk, right, on the conference room, and he's like, "You should go home and study this. This is the webvan business plan." And I'm like, I don't know what to do with this. Like, I don't have a floppy drive. Anyway, but instead of sort of like, running away from that, right, we addressed the elephant in the room. Our slide deck changed. Immediately, the first slide said, webvan done right. And so instead of people sort of bringing up that obvious question, we're like, okay, let's go, right? And the thing is that, if you look at some of the biggest ideas in the world, it's not like they're new, right? The big ideas are always things that humanity has been working on, right? And so, of course, grocery delivery is not a new idea, right? But a lot in the world has changed, and there's a lot to learn from webvan's failures. Number one, they couldn't figure out how to scale across the country and across the world economically, all right? Number two, they couldn't figure out their unit economics because they had to have all these people and all this inventory and warehouses and trucks that they had to buy. And so we would start saying, well, look, things have changed as a result of the fact that smartphones are now so prevalent. Now, if you want to order your groceries, we can connect you with someone who is already close to a grocery store who could pick and deliver those groceries to you. We're not holding inventory, we do not have warehouses, and we're not buying any trucks. And so that means that it takes us, a couple of weeks, less than a couple of weeks to launch a new market. And it takes us, at least at that time it was projected, a few months to get to profitability. And so things were very different, and we just had to communicate that. Now, did that mean that the world recognized that? No. Instacart, if you had polled people over the first 5 years, right, people outside the company, if Instacart was going to be a company that's going to exist, the answer is no. It took a lot of work from the team to make the company inevitable. And, in fact, like most seed stage companies, that's what you're working on, is making the company inevitable.
You mentioned funding. Let's talk about some of the early rounds of funding. What was the experience like? Tell us about some of the rejections you got. Any interesting stories from that experience?
Lots. I mean, we can focus on that session, the whole time. We'll talk about YC. I know this is a pre-seed conference, and so I applied like very late to YC, like disturbingly late. The batch was already in progress, and so I tried to apply, and they told me you can't apply, and so I got a few of my friends to introduce me to YC partners, which they did, and then unfortunately one after another they all sort of said no, it's too late, until this one guy, Gary Cahn, he saw what we're doing, and he was like, look, you can probably apply late, and if I had to guess, it's not gonna happen, but like you can apply late. That's what he said, right? The way I took at it is that I think you have a chance, right? And so I applied late. Next day, got rejected. And I was like, I really don't even think that they actually understand what the product does, right? And why it's different, and why, we're gonna win. And so I opened up the Instacart app and placed an order for a 6-pack of beer and addressed it to Gary Cahn. 30 minutes later, I get a call. I thought it was gonna be like, hey, thank you for that beer, right? No. It was, what is this? And I told him, this is Instacart. He invited us to interview the next day, and Instacart was part of YC right after.
And one of the best investments I've ever made. As my wife always reminds me, no is a yes in the making, and it sounds like that is your belief in life, and it worked.
We got lucky. Yeah.
In the early days, I heard you did some of the deliveries yourself, right? Talk about the polygram, do things that don't scale. Any interesting stories from that? What was that like? You're an engineer, you worked at Amazon before, doing grocery deliveries. What was that experience? What did that teach you?
I mean, so much. I mean, of course, I'm sure all of you guys do this anyway, but you got to be very close to the customer. You have to understand their pain points better than anyone else does. That is, at the end of the day, why a company wins over its competitors. In the early days of Instacart, people would just be placing their orders on the service, right? Thinking this was like a legitimate operation. But behind the scenes, it was like a one-man show, right? The person who was writing the code for that was the same person who was delivering their groceries. And if they called, it would go to my phone
So funny.
as well. And so, the only problem was that I didn't have a car. And the thing is that, this is back in the day when there was no, Uber X. Right, there's only the Uber limo service, right, at the time, and so a lot of times when people would order, like they would see their groceries arrive in the luxury of a limo, right, and at the same time it was an incredible learning experience.
That's amazing. Do you remember what's the weirdest thing somebody ordered in the early days of Instacart?
so many weird things. You get to really know people.
Whether you like it or not.
There was this, I got a call one day, right? It's one of my shoppers in Palo Alto. And she's like, hey, I don't know if I can do this. I think I'm going to quit. I'm like, what? Like, what happened, right? And turned out that she had just got an order for 200 bottles of those 2-liter bottles of soda, right? And she's like, I don't even know where I can find these, right? Let alone, like, where am I going to fit this, right? I don't think this thing's for me, right? And I'm like, all right, hold on. Just pick me up from the Caltrain station. And I didn't have a car, so, like, and we're going to do this order together, right? So we did, and we had to, like, clear out, like, 3 safe ways to do this, right? And there was, like these soda bottles were everywhere. Like the trunk was filled, the back seat was filled, the front seat was filled, right? And the order was at Y Combinator because they started using Instacart, of course, right? And we show up there, we lug out all the bottles of soda, right? And the office manager is there, is like after that, is like, oh my God, thank you so much. That was so easy. I'm going to do this every week. So we just had so many incredible stories. You get to really know people.
Oh my
God. It was awesome.
Yeah, you're like, it was easy, of course. Super easy. Keep ordering. So you started with an idea. The company's worth over $10 billion today, but it wasn't always up and to the right. June 2017, Amazon announces they're acquiring Whole Foods. For a lot of us Instacart customers, Whole Foods was the reason we were on Instacart. Tell us when you heard that news. What went through your head? How did you pull through?
Yeah, I like to pride myself, I guess, in being a little bit of a paranoid person. But when I found out about that news that day, I'll be honest, like, that was a gut punch. That was not on my 2017 bingo list that Amazon is going to buy Whole Foods for $17 billion, right? This is not something I had expected. And to give you the sort of the significance of that and why that mattered that much, it was because Whole Foods was, not just the most important partner, kind of the only partner we had, right? I think about like 30 to 50% of our sales came from Whole Foods. And so this was just like, nuclear Armageddon. Like, this was that, like, really big deal. Like, I would get just so many text messages from people saying, hey, thinking of you. Right? It's just like, that's not what you want to hear, right? And so I was like, okay. I heard the news in the morning. I told the team that we're going to do an emergency all hands, and we did. And there, I told everyone that we are entering wartime. And the way we're going to be working for the next 12 months is going to be at a different pace, at a different level of focus than we have ever done in our entire lives. And that, of course, I just had a couple hours to think about the plan, but we don't have a plan yet, but we will in a couple of weeks. And in a couple of weeks, we laid out the plan, which was our focus was going to be on 2 things and nothing else. Everything else in the roadmap, put aside. That was, number 1, to sign every major grocer in North America. And number 2, to retain people who had used us for Instacart, and retain customers who had used us for Whole Foods, to stay on our platform. And our team got to work. I mean, I've never seen our team work this hard, this focused. That meant that, if there was any retailer, regardless of where it was, we would go see them almost immediately. We took away any reason they had not to partner with Instacart, whether it was building features that allowed us to launch, tiny markets that, wouldn't have made sense earlier, whether that was launching Instacart Enterprise, whether it was launching 500 different other features. Our team made all of those things happen. And, not 1 year, but 9 months later, we had signed every major grocer. And by the time Whole Foods left the Instacart platform, they were 1.5% of our sales. So from 30% to 1.5% of our sales. And that was because we launched all these wonderful retailers where people really wanted to shop. And, I guess if you continue that story today, because of the team's execution during those days and of course after, Amazon grocery is a small fraction of the Instacart grocery sales at this point. And that was really because of what at the time felt like a gut punch, but it allows us to execute at a pace that we'd never seen before.
As they say, never waste a good crisis. And it sounds like you did not let that one go. Was that a culture building moment? Do you feel Instacart was a stronger company almost because it happened?
Definitely, never waste a crisis. And it's so hard as a leader. It's so difficult to manufacture the external propaganda, that we had in moments like that, where everyone knew, if you were working on anything else, it didn't matter, right? That level of focus, that level of clarity, it's so incredibly hard to buy. And it allowed us to accelerate what we wanted to do. It allowed us to get the most out of our teams in a way that was not possible before. And today, if you talk to anyone at Instacart, or who was there at the time, I guarantee you that was probably one of their highlights in their entire work history. So truly incredible.
So you get past this crisis in 2017, 2018, and then March 2020 happens, right? None of us predicted that to happen. We're at peak lockdowns, and suddenly everybody is getting their groceries through Instacart that wasn't on Instacart before. I got calls from my parents saying, we just signed up for Instacart and we got a grocery order. These are not the most tech-savvy people. They were not on Instacart before. You probably saw an incredible surge on demand. How did you keep the wheels on?
Yeah, it was probably one of the most important sort of times in the company's history. So this was, at the beginning of January 2020, I think we were doing about $7 to $8 billion in annualized sales, right? So not a small company, but not that large either. We were all seeing the news, what was happening in China, and it just didn't make sense to any of us. They're like, okay, why would this only stay in China? This has gotta come to the United States as well. And then we saw our order volume. We're like, interesting. It just grew by 10% week over week. And so just put that in perspective. That's we just added $700 million in ARR, right, in a week. Okay, not seasonal, but I don't think anyone was they're like, hey, this is pretty good. And then the second week happens, and guess what? The same thing happens. And we're like, okay, so we just added 770, million in ARR. All right. And I remember, right, at this point, of course there was they were growing, and we're basically meeting our 6-month goals in a matter of weeks, right? But at the same time, there was this nervousness because it also meant that, all of our infrastructure, which was designed for, to keep up for 70 to 100% year-on-year growth, right? We were seeing that amount of growth within a matter of weeks. And we're like, okay, well, we're gonna need more servers. We're gonna need, everything to be, redone if we wanted to keep up this growth. And we were having this discussion internally when, boom, lockdown. And so at this point, everyone and their grandma was using Instacart, right? 10% week-over-week growth. I mean, forget about that. Like, that was that was easy. People were waking up. We were getting these anecdotes, right? And we were seeing this in our data, where people would wake up at 4 a.m. because they wanted a delivery slot, right? Yeah. And it would get filled so fast that people wanted to wake up at 4 a.m. to place an order. People would, email anyone they knew at Instacart to say, "Hey, my grandma's really sick. She needs the grocery order." And so, on the one hand, this is a team that is navigating, keeping their families safe and navigating how to work from home, from their kitchen tables, right? On the other hand, this became now, not about growth, but it was about okay, well, we have this incredible responsibility for our communities. And so at this point, we called a wartime. And literally everything else the company was working, the whole roadmap was shelved. Because the only thing that mattered during this time was that we were there for our communities. And so, over a matter of weeks and months, we onboarded 500,000 shoppers. That's close to the population of San Francisco. Yeah. We onboarded them so they started to pick and deliver groceries so that, when someone's grandma ordered at 4 a.m., they had availability. We made sure that this was done safely. So we created a completely new supply chain so that we had enough PPE so that we're able to make sure that our shoppers were staying safe during this time. We worked with our retailers so that our shoppers were able to get into the stores at a time when, other customers weren't there. And as a result of this, what started at the 7 to 8 billion in sales ended at about 25 billion in sales that year. And to put that in perspective, that was also around the time when Amazon Prime and Target and a bunch of other companies completely shut down. They couldn't handle it. And so this was an incredible time. This was a crucial moment for the company, and our team stepped up and delivered.
So the text messages from your friends went from thinking of you to I need you in 3 years. And it's a reminder that it's not always up and to the right, and even when you're doing well, there's going to be ups and downs. I want to switch gears a little bit and talk about team building, because that is a big thing that a lot of our founders here spend time on. In the early days, talk about what you looked for in talent, learnings from what worked, what didn't work. How did that change over time? And one of the questions from the audience was around these crisis moments. How did you keep the team motivated, right? How did you have attrition on the team? How do you keep the head high, and how do you get people to power through that?
Yeah, I mean, there's a lot of questions, but let's talk about, I think, team, just on an abstract sense first. There is just this, I think there's this power law that exists with team members, where there's people you meet that are just going to be, good, and they're going to do good work. But there's people that you meet and that have a chance individually to change the trajectory of the company, right? And there's just very few people like that. Very few, right? And for those people, you should do everything in your power to convince them, to do whatever it's possible to bring them in to the organization. Because, those people are the reason why we were able to navigate the Amazon Whole Foods crisis, the COVID crisis, and so many others that people don't even know about. It really is about those individuals. And so, and in terms of attrition, believe it or not, during any of those times, Amazon Whole Foods and COVID, we had, I don't know the exact numbers, but I think in terms of all the key people in the company, 0 people left.
Wow.
0. It was not oh my God, we're losing some key people. No, there was no one left. And the reason why is because, these are people who you trust to go to battle with you, and they appreciate that. And you ask for them for help during those times, and they're there. So I'm just a big believer in that, and I think that at the end of the day, that's what differentiates great companies from others.
But say more, what did you look for in the early days, especially in terms of talent? Because I think you brought in a couple of co-founders, late co-founders to the team. What made you feel comfortable to give them that title, to bring them into the team? And any advice you would have for folks that are looking to build a team in the early days? What is the right talent, and perhaps what's not the right fit for that stage?
Yeah, I mean, look, I think that judging talent is a surprisingly hard thing, and it takes a lot of time, a lot of interviews, and a lot of failure to build that intuition that allows you to know after maybe 60 minutes of a conversation that there could be something interesting in this person. And so, yes, there were some wonderful people that we brought on, and in many cases we got lucky as well. But it took me some time. It took me some time to understand what great looks like and how to evaluate great quickly. And I think that as a tactic to figure out how do I know? How do I interview someone and very quickly understand if they are the right fit for what we're doing or not? One of the things I did was I created this 20-point checklist, and not 5, but 20. And this was it wasn't for the whole company, it was just for me, right? So that I would evaluate people on that 20-point checklist, and I would just keep score over time to understand, which axis did people miss on that I hired and, didn't work out, or they did work out. And so it was that continuous improvement mentality on hiring and on talent that you just have to have. You're not going to be excellent at talent on day one. It's going to take time, just like anything else.
Well, let's unpack this a little bit, the checklist. That's really interesting. Do you remember what were some of the top drivers on that checklist that you found over time to be the most correlated to success?
Yeah, I mean, that's for me. And it's not the case with everyone, right? And so everyone has their own style, their own chemistry, their own values. And so the things that I value, there's of course all that, there's obviously sense of urgency, agency, and things like that. They're like more standard that you look for. But the things that I guess were uniquely some things that I was looking for were, number one, are they a structured thinker? Right? Like when you give them a problem, do they break it down into say, okay, well, these are the 3 key components. This is how I would solve it. All right. That's like something I just care about. I just want that in people that I work with because, grocery delivery is a very hard problem. You have to just break it into pieces and then you can tackle it. And that was one. Another one, for example, was, this is just like very difficult, but it's like something that's like very important to me. Like, how much do they want to win, right? Like, there are people who are just like fine with doing a job, right? But do the people that I want to bring on, do they want to win? Like, how much do they desire every day to win, right? And you can see that in people, and that's what I cared about.
Fascinating. And were there cases where perhaps you hired somebody that wasn't a fit? What did you do in those instances?
Lots. I mean, it was not because those people weren't great. They were great, but it's just not the right fit for us. And I think, I think Vinod Khosla has this thing where he's like, look, you're going to get lucky if you get 30% right. And I think, I didn't know that then, but I think he's absolutely right. It takes time to build your intuition to say, okay, if you, what is your batting average going to be? But initially, it was terrible, 30% batting average. And I think probably now I can probably do 70, but it's not perfect. And it's not perfect not because of that individual or because of your intuition. It's just also a dynamic environment, right? The company that you've started interviewing in is a different company by the time they join, and then you put them in an environment where, hey, it's a different company every 6 months. So it's like the pattern recognition is tough, right? And so I think that it's not a static problem, and so you're gonna have when it's a moving target, you're gonna have mistakes.
I think being comfortable with that level of uncertainty is one of the characteristics we see in successful founders, right? Just being comfortable that you'll never have the perfect answer, not everything will go well, whether it's pre-product market fit, post-product market fit, post-IPO, whatever the case might be. I think you just have to be comfortable with that volatility. There's an interesting question from the audience I want to ask you. Is Instacart exactly how you imagined it? And how has that evolved over time, and how have you taken feedback to apply to the idea?
That's a good question. So, is it exactly how I imagined it? To be honest, my imagination, the company was $1 trillion company. So, there's maybe a couple zeros.
Couple more years.
Yeah, they're remaining still. But, in a lot of ways, it was exactly the way we imagined it, which was, when you're starting an idea, right? It's a complete blank slate. There's nothing, right? So when you're like, okay, well, how, like, when I open up the app, am I gonna see a warehouse that I can order from, or is it gonna be all the local stores, right? So we made certain decisions in terms of, okay, we're gonna partner with local stores. We're gonna work with advertisers who have products in those stores. And we're gonna have crowdsource people to pick and deliver groceries, right? And we're going to do this in every market around, anywhere, right? So a lot of those things are true. Those are exactly right. Now, this is, when you're building a company, your imagination does not stop, right? It's not like, okay, your product market fit, hey, that's the imagination. That's how it's going to go. No, it just continues. And just, you want to keep imagining it and so I'd say in the early ideation phase to where the company is today, I think that it's been pretty dead on.
Amazing. You've achieved what a lot of founders aspire for, taking a company public, worth over $10 billion and growing. What is something that no one tells you about success at this level?
It never stops. Your desire to continue to win. You want to keep going. You want to do something bigger. And I don't think I ever thought about like, okay, would I want to do something? No, but it just never stops. You want to always do something bigger.
You just love the game.
Yeah.
Right? It's not about any one milestone. It's a journey that matters more. I think this is another thing we see in founders, successful founders, is that there is no end state. And if the company exits or they sell and they move on, they want to start again, right? They just want to keep doing it, even though it's, as a lot of you know, painful to build companies. It's highly risky, but they just can't see themselves doing anything else. What do you want to do next?
Build something bigger.
Sucker for punishment. I'm going to do a rapid fire. We got a few minutes left. If you had to pick one, timing, talent, or pure hustle, what mattered most in the early days of Instacart?
I mean, hustle. It was all hustle. Hustle allows you to make it the right time. Hustle allows you to make sure that you have the right talent. And so it was all hustle.
Amazing. Biggest pinch me moment at Instacart?
There was this moment during COVID where, we were just like trying to keep our servers up and just make sure that we were, around for another day. When one of our shoppers sent a photo and it ended up in our Slack room, right? And it was a photo of some house's main entrance, where there was someone had put a blackboard there, and it was like clearly like kids just drawing with some chalk, right? And they're just saying, thank you Instacart, thank you Instacart for keeping us fed and healthy, and that was just such a galvanizing moment for the whole company, because it was just like people were working 18-hour days for for weeks, keeping the site up and running. And it was just like, this is why we were doing it. So, it was just incredible to see that.
This is from the audience. When will you add Trader Joe's to Instacart? And the person said the people are waiting.
That's a really good question. Funny story. In the early days of Instacart, right, there was these grocers had no reason to trust us, right? And we were lucky if the store manager would even return our call, right? But it was clear that people wanted new stores on our site, but there's no way of getting the catalog information, right? There's no way to know what the store sells, let alone what's in stock, right? And so we decided, when we walked into a Trader Joe's, and with an army, we brought about 30 people with us, and we bought one of every single item at the store. We took it to a studio, took photos of every single one of those items, and the next day, Instacart had Trader Joe's, and we doubled overnight. And obviously we ate really well for a few weeks after that because we had all this leftover. But unfortunately, the decision of Trader Joe's on Instacart is not a decision that is on Instacart. That is that's Mr. Joe's decision, and we hope they are open-minded about the possibility.
I'm just picturing the cashier who rang you.
Oh, they loved us.
They thought it was the weirdest order ever. Why do you need everything but only one? One tomato, one avocado, but you also need diapers and toilet paper. The same.
Let me tell you that after that incident, the store manager always returned our call.
Fair enough. Who's a founder you admire the most?
I mean, there's just so many incredible founders in our time. This is going to be obviously sadly a cliched answer, but look, I think Elon Musk is the one of the best founders of not just our time, but of all time. And I think it's just so crazy to be a contemporary of someone like him.
Yeah, that's right. One piece of advice you ignored, you wish you hadn't.
Talent is more important than anything else.
Favorite thing to order on Instacart?
I order everything on Instacart, everything. So I don't know what to tell you. Bananas,
Speaking of Instacart, if your startup life, this is a final question. If your startup life was a grocery item, what would it be?
I was prepared for this question. And I was also eating this, when I was thinking about this question. So I think it's reasonable. It's a salted pistachio.
Okay.
And it's because it's you got to crack that nut, right? It's hard to crack that nut sometimes, right? But it's delicious and it's very addictive. All right. And so I don't know. Somehow those dots connect.
Interesting. Love it. Well, with that, I've really enjoyed this conversation.
Awesome.
So thank you so much. Really appreciate it.
Awesome. Thanks so much.
Guys, we're going to start the VC panel in about 2 minutes, yeah?
Oh my God, I need like, all right. Hello, can you guys hear me? Clap once if you can hear me. Clap twice if you can hear me. Works for my 3 kids, so great it works for you guys too. Well, hi everyone, my name is Kristina Shen, and I'm a partner at Chemistry, which is a new fund that I started fairly recently with Ethan Kurzweil and Mark Goldberg, and we're a $350 million early stage venture fund leading seed and Series A. And so today I got the privilege of moderating our VC panel today. So I think I could give all the intros, but I think they will do much better intros than myself. So David, why don't you start?
Cool. Hey, everybody. Thanks for having us. I'm one of the partners at Sequoia. I'm the new guy at Sequoia. I've been at Sequoia 2 years. Before joining Sequoia, I was leading the venture fund for Co2, doing seed Series A investing. And I'm on the growth fund now at Sequoia. So I've done everything from seed through late stage investing.
Hi, my name is Mar Hershenson. I'm one of the founding partners at Pair VC. We are in our 4th fund. It's a $400 million fund, and we do pre-seed and seed generalist. And before Pair, I was a founder myself, and I consider myself an engineer, deep at heart.
Great. Hey, I'm Alex Kolicich, one of the founding partners at 8VC. We're a generalist fund. We'll invest, I like to say, in almost everything. We do software, biotech, healthcare, defense, some consumer. We focus mostly on seed, Series A, Series B, and I think we have over $6 billion under management now.
Awesome. So we're going to kick this off fairly. By the way, there is Slido, which I think you guys all know. Please send your questions in, and I will make sure to try to ask as many of them as possible. But as we were chatting backstage, we said, what are we a VC panel without actually talking about AI? And so maybe I'll kick it off a little bit, which is, I'd be curious to hear where the 3 of you feel we are in the AI cycle in terms of, what did you believe 6 months ago? What do you believe today? And what do you think is going to be interesting in the next 6 to 12 months? Maybe I'll start with Mar, since you're at the earliest stage.
Well, I'm still so impressed that all we can build with generative AI, that part of me thinks we should be paying a lot of money for all the companies that come through our door. And then I realized that the fund is only this size. So I'm old. I was saying backstage that I'm old enough that I was here for the internet bubble, and then I was here for the mobile bubble. And humans always behave the same way. At the beginning, everybody rushes in, and there's this kind of peak of excitement. And I do feel that in 2023, it was crazier than today in terms of the deals that were getting done. They weren't even diligenced. I think people hadn't even thought it through. And right now, the companies that are getting invested, at least they are more thoughtful, and they have, they're going to have a higher rate of success. So that's what I think. And I know there's a lot of comparisons as to how impressive this is, and comparing it. First it was the PC, and then the printing press, and industrial. Everything is like, anyway, it's going to be like the wheel at some point. But it is really impressive. So I think there's a lot of value to be created over the next decade.
Yeah, I've been writing about this for a couple of quarters now. We're generally at the fund pretty bullish on AI in the long term. We think, there's a little bit of feedback. We think that in the short term, we're not right before, but close to the trough of disillusionment, if anybody knows the Gartner hype cycle. We're really close to the Palantir team on AIP side, so we do a good job of, I think, keeping close to the market. And there's definitely value being added in enterprise with AI applications today, but we're still early, I'd say, in that deployment cycle. If you look at model performance, it looks like it's starting to plateau. If you look at the model providers, you're starting to see convergence in performance. And so that all kind of suggests to us that the scaling laws are not, I think, going to generate any immediate performance or step function performance increases, which means I think we'll fall short in the next year, 2 or 3 of the inflated expectations of what people think. And that's really only because I think the expectations are so inflated. You can look at NVIDIA's market cap to see what the projections are. I don't think we'll quite go into that of like AI apps making billions of dollars of revenue, but I think within 5 years, we'll probably be shocked at how much has changed with AI and how real it actually is.
Well, I mean, David, you get to see it at the other end of the spectrum, being on more on the growth side. I'm curious, like as AI companies are starting to hit your stage, people talk a lot about GPT wrappers versus, how do you stand out? How do you create a moat with AI products? I'm curious to hear your thoughts and maybe involve some of the companies you've been with.
Yeah, I would say, maybe just to calibrate, I think there have been great AI companies for the last decade. And I was lucky enough to be involved with companies like Weights and Biases and Hugging Face, and there was a generation of companies in the 2017, 2018 era that at the early days of deep learning were already talking about and thinking about what this technology was going to become. And I think it's also important, this technology is actually like live, affecting people's lives. Like John Deere's tractors use AI to spread like the fertilizer and the pesticides and all the things. So I think, we already have AI in the real world. And so I just think it's important to distinguish AI from generative AI and sort of the hype cycle that we're currently in. And I think about ChatGPT as sort of this like great instantiation of this technology and great instantiation of this idea, which is like, hey, we have computers, we're able to write software, now we're able to make these computers intelligent. And I guess my belief is that ChatGPT is going to be one of many instantiations of what this looks like. And so we may be at the peak of inflated expectations on sort of ChatGPT equals AI, but we're certainly at very early in what is actually AI. And so I think as we think about companies reaching the growth stage, the thing that we pay attention to is there a user who's ultimately getting value, right? That's the ultimate thing that you need to get to by the growth stage. And so John Deere is getting value from AI. If you have an AI widget that's in search of a market, then that hasn't created value yet. And so I think that's the tension.
And, please, Mar.
I just want to maybe say something. I know there's hype, but if we ask our portfolio companies how many of our teams are using Cursor to write code, it's going to be very high. And imagine all of us seed managers, if we could cut the engineering by half, it's a huge impact on the money that we put in. You can double the runway, or you can do more with the same amount of money. So I feel that AI is here for some stuff, especially in the Valley. There's no hype. If we had sat down here 2 years ago and said, hey, there's some magic thing that will cut your engineering team in half, nobody would have said, oh, yeah, you're totally right. But it's true. It's happening. I think Google said 25%. Small companies more aggressive. So I think that's a big deal. Customer support, it's definitely happening. And that's massive amount of people that are working there. So it's high, but it's also here, and once it gets adopted super rapidly, right? Anyways, not to be contrarian, but just making that point.
I mean, what I love about what we were talking about backstage, actually, is like, remember with the cloud transition, you used to have to give away 50% of your company to even turn on the lights to start your software or cloud business. And today, you can now build who knows how much faster. If it's 25% or 50%, your engineering team can be accelerated via Cursor or other such products. I think there's huge opportunities for transformation. I think as investors, the biggest challenge we're always facing is there's no doubt this platform shift with AI is going to be transformational for new companies. The question is, where does the value accrue? Another question that comes up a lot is, how do you think about what industries you think it's going to hit first? And so I'd be curious, maybe starting with Alex, are there particular industries that you think are most primed to be adopted against?
Yeah, I generally think that we're vertical software investors in the more cloud cycle. So we think about it from an industry perspective. How do you add value to the end user? And so we invest in a company called Cognition, which everybody's probably heard of, Devin, the software engineer. I think that's like one way in which you can think the applications software stacks can be reimagined. Like you can think of these multi-agent systems existing as a standalone software company in every single vertical. I'm on the board of a company called Qualia, which is title insurance software, and we power title agents. And you can see the Devin, we call it a Patty, of the title agent. Like you could see that starting to develop today, where you'll have these multi-agent systems where the user is almost like supervising a team of employees. I kind of think that's where vertical software is going to go, and so we're particularly excited about that opportunity. Then there's the go-to-market question people are asking is, do you want to sell software or do you want to do more of like a services, AI services roll-up? I think that's more of a go-to-market question, but that's kind of how we see the application stack evolving. And then we're actually pretty bullish on vertical software itself. I think the default is that An incumbent, if they're smart, will launch, I think, the AI multi-agent system or single agent system or straight API call and deliver that AI to that industry because they have the data gravity and they have the workflow gravity. But if they stumble, I think it's like prime for somebody to come and disrupt them with this new sort of like application paradigm. That's how we're thinking about it.
All right, I'll try to get an audience question. What are your thoughts on the interfaces where agents perform actions without prompts?
Without prompts.
Without prompts. And so maybe I might reframe the question a little bit as to curious to the different ways you think we may democratize agents where the interface is not actually a ChatGPT interface or other ways interface that we might interact.
Well, I can envision it for regular workflow software in a vertical. You don't necessarily need a prompt. Like if we go to title insurance, which is like the most esoteric space ever, but the workflows are pretty well known, and you would know the like state diagram of like steps you have to go through for the agents to complete. And you could and the human would just be in a supervisory role. They wouldn't be necessarily commanding the AI to do what it does, because in most workflow software, the workflow is known. And so I think of the human as kind of the grader, not even like the prompter, but the grader saying, okay, you didn't do that right, or here's a piece of context you don't have. That's kind of the way I envision it.
Yeah, I mean, it's. I think it's already happening. We have investors in a company called Orbi that basically just watches you, and then it figures out, oh, I know exactly what you're doing, and I'm going to get it done. We're also investors in a company that is looking at all this this massive industry, which is software implementation for things like SAP or whatever, and it can watch the implementation people do it and just learn and do it. So this is already happening. It's not like there are companies that don't use chatbots to do it. It might be that the customer doesn't trust it, and you have to give them a little window to stop, but it's not, with every technology, you might need that for some people, and it goes away pretty quickly.
Very cool. I mean, I'd love to switch gears a little bit. I see lots of questions about the venture industry. So we're going to switch gears a little bit over to, I mean, I'm curious to, maybe I'll tackle Mar first. The venture industry has changed a lot over the last decade or two. And in particular, a lot of funds have gotten bigger. And so I'm curious, how you think about returns as fund sizes have gotten bigger, the impact to founders as the pressure of larger raises happen, tied to larger fund sizes. I'm just paraphrasing a question here, but I'm going to target you first.
Okay, that's a very long question. So yes, venture has changed a lot. I started my first company in 1999, so that dates me. I'm the oldest person in this room, probably. But it was very different. I think in venture, there were some people in Sand Hill Road. They didn't have a website, and they just waited for founders to show up, right? That was venture. It was this merit, it was very different from our job today, which, we are salespeople, and I feel like I'm always running around chasing somebody, So I think it's going to continue to be, I believe it will continue to be more and more competitive over time. This is not an easy job. And when I tell people, I say we're in the Olympics of venture in this place. So it's getting just harder, period, for everybody in venture to return funds, because there's a lot more money in it. And there's a little bit of a I don't know if it's a physics constant or something, but it's just that many amount of great founders every year. There's just not infinite supply, and we're all chasing them. So that's in general, I would say. Now, the exits are getting larger. I think a 500 million IPO was amazing in the 90s or the early 2000s, but
how much revenue did that company have?
Exactly. But now it's not, the companies that are actually making it are really big, right? So again, I think it's transformed a little bit from a business where you could take your time to do a deal, pick your thing, and hey, you might get some exit, to like super hard picking. You have to be really good at this business, at that picking, and then doubling down on that winner, because those people are going to exit, or super big. So anyways, Sasha, you have to be good. That's, that's my summary.
Well, what about well, maybe switching gears a little bit. We were talking backstage a little bit about types of founders that we get excited about and how we think about investing at the earliest stage. Maybe we go down the line a little bit, and maybe we'll start with Alex. Especially at the early stage. I mean, 8VC has been investing seed and Series A for how long now? Over a decade?
Yeah, almost, yeah.
Over a decade at this point. What do you look for in founders?
There's the common elements, and then everyone's unique in their own way. I'd say we generally skew towards technical founders in particular. So that's like number one. We like people who are technical, if we can get it. Not everybody has to be technical, but we generally prefer that. I find every founder is like a little strange as well in their own way. And so I think you have to be a little off in some dimension to want to start a company. And I think that's a good thing. I think that uniqueness is what lets people have like unique insights about a market. I think you have to be good at recruiting. You know, we call it internally resource magnetism. You have to be able to recruit capital and people to your cause. I'd say like those are the most common elements that we find.
Okay, this is my most popular question. So everybody wants to know, and I tell people that it's the same as saying, hey, how do you pick your wife? Okay, you know, it's really hard, right? Because should you date it and so on, and you want certain category, certain qualities, but there's some intangible that people are looking for, and that's great because different managers have different tastes, right? So, and in a way, that's what, you know, makes our seed funds differently. Anyways, that's what I would say. I tend to really try to understand the why they're building the company, and just know that 50% of my companies will pivot, right? But if at least they can articulate why they're building the first one, I can see how they're thinking, and that really tells me a lot. So that's what I do.
Yeah, I would definitely reiterate what Mar just said, which is that I just try to pull on this thread of like, what are we all doing here? Like, why are we doing this? And I think as you pull on that thread, you sort of get a sense for someone's life journey and what led them to this moment and why did they start this company. And I think I was chatting with actually an Afore founder that I had the privilege of leading their Series A that recently got acquired. And we were just talking about this question of like, what are we doing? Why are we doing this? And I think the best companies, there's a really authentic answer to that question. Like we heard Apoorva earlier, like he was going to make that company work no matter what, right? Why? And he understood that. And I think the best companies, that's why they're able to mobilize resources. That's why they're able to get capital. That's why they're able to get people, because there's a cause, there's something deeper there that they're pursuing.
I always like to learn something new in the conversation. And so, especially if it's a market I know well, if I learn something new, that's an aha moment for me, because I should never know more about your market. And the flip side is true too, which is I will always test someone, which is I will test to see if you know a lot about a particular area. And if I catch you in a lie, that's also a bad thing too. So a lot of people just ask me, what's the biggest pet peeve in a pitch? My biggest pet peeve in a pitch is when you try to over-exaggerate something that you think you know, but you probably don't know as much about. And so just remember that like it's a trust relationship. I think the marriage analogy is so perfect. It is harder to get divorced from your board partner than actually your actual significant other. So you're really stuck with us if you pick us.
Actually, I'll tell you a funny story, but you're totally right. A long time ago, Pashman and I, our website, we didn't have marketing, so we're like retelling our messaging, and we're like, we're immigrants and we love immigrants, and we have this. We like people that are, that are courageous and so on. Anyways, it was just marketing. But then we noticed that everybody that came to pitch to us had an immigrant pitch about the whole thing. So anyways, I realized. So you want to catch that as it's not true, but anyways.
We were talking about early stage. We were talking about pivots earlier. You pivot a lot. And I'm actually curious because, Alex, we were chatting backstage about this. How do you think about pivots? How have you worked through it with companies? How do you think about an early stage founder who's already pivoted a couple times before you're talking to them?
Yeah. Actually, I was having this conversation a little bit with one of my companies last night. We had a board dinner of like, well, there's two questions here of like, how do you know when to pivot or what's the value of a pivot? And then I think it actually goes to where an investor can add value. I was telling them that I think if you're a board member in a company, you're usually you're more divorced from the details than the company. The only thing you can provide is a little perspective, like top-down perspective. Market perspective, or just more of a macro view, a set of fresh eyes on what they're working on. So I generally think a board member or an early investor could provide 2 or 3 pieces of great advice to the life of a company. And I think one of those is when it's time to pivot, when you're just saying, hey, I've seen this, I don't know a lot of stuff, but I've seen this before, like it's not working. You're pushing on a string, it's just not gonna happen. And so I think having people around you that can give you that perspective of when it's not working, that's one. And then 2, for the importance of a pivot, I mean, I think almost, I don't wanna say every company I've invested in, but probably half of them at the early stages have pivoted and become successful.
What's one of the most crazy pivots that you saw?
Yeah, I mean, we were talking about this before, but we had a company that started as a mobile app company. This company now is called Hive AI, does content moderation, doing a lot of revenue anyway today. And they started as, if anyone's ever tried Omegle, the like random chat app, they started as an Omegle clone, then they became an Ask.fm clone, and then they became a Scale AI competitor today, and then now they do content moderation API. So they went from like consumer internet all the way to enterprise AI, and their moderation APIs are now best in class, better than Google. There's a little lineage to that because they had to do moderation on the consumer app, so they had to build those models. But I think that was like a really good lesson in tenacity. It's been 10 years now. They're doing, I won't out them now, but a lot of revenue. And I asked him once actually, like, what's the secret to startup success? And he said, I think 99% is just not giving up. And I think that's true. Like, one of the things we now filter for at the fund is, does this person have the tenacity to keep going? Because it's going to be easy to quit, start a new company, sell the company. Like, there's lots of times you can just give up. But honestly, if you just keep going, you don't take no for an answer, and you're willing to pivot and try new things, it kind of usually does work. Like, that's the weird thing I've learned about startups.
Anyone else have any really fun pivots?
Just want to say something about pivots, maybe that may be helpful for folks. But I think you're totally right that our role is sometimes to just tell the founder it's not working, and I call that an intervention. So I'm like, I'm gonna have an intervention with this company, and I know that the reaction of the founder, it pisses me off because many people don't tell that to the founder. They want to be founder friendly and not say it. And you're hurting because they're just burning your cash. So when you know, you should have this conversation. And they go to the 5 stages of grief, which is denial, and they get upset. And I'm like, dude, the sooner we get to acceptance, the faster we're gonna move, So, but it's natural because you're grieving your company, right? And that's what goes through their mind. But I find that, you learn. I mean, we are making these decisions about marrying somebody through a few meetings, right? It's really hard to get it right. But when you've worked with a company for 6 months, you have a lot of information about that company, and you should absolutely rethink, right? Is this the founder we should pivot, or should we call it a day, right? And I think that's maybe tough, but it's the right thing for the fund, for the founder, for everybody. Not everybody deserves to pivot. That's, the way I would say it.
I also think pivot many times gets used as a dirty word, but it's actually a great learning opportunity. Like, even listening to the Hive story, there was some continuity in what they learned at each stage of their evolution as a business. And so I do think a lot of times it gets thrown around as that, oh gosh, they pivoted 3 times. I view that as the faster you pivot, the faster you're iterating. And so I would say, I think, famously YC founders pivot all the time, right? Like, I think I've invested in, a dozen companies, of which more than half have pivoted along the way.
I think the pivoting is also correlated to this founder trait that we were talking about, this like truth-seeking mentality. Mm-hmm. And I think that at the end of the day, one thing that I share with a lot of founders, my friends who start companies, and we talk about when you're starting out on the journey, what's something to be aware of. And I think one of the things that hits you on the startup journey is there's a lot of people who are incentivized to tell you what you want to hear, especially when you first get to Silicon Valley. And I think that's investors. I think that's potential employees. I think that's employees after they join the company. There's sort of a lot, customers, by the way. I was chatting with a couple of juniors at Columbia who are starting a company, and they're telling me about their like product discovery journey and just all the people who told them how great their idea was until they figured out that it wasn't a good idea, right?
Show me your credit card.
Yeah, exactly. And so I think there's this like truth-seeking founder element. And so I think there's almost this reverse causation, which it's not that companies pivot and therefore they're successful. It's that the founders who are willing to pivot are the founders who are looking for the disconfirming evidence in every interaction that they have. And when they identify the disconfirming evidence, they change their thesis. And the thesis is coming from inside of them and is getting updated with new information. And that's why I think these companies pivot and ultimately become successful.
I always think examples are really helpful. So I invested in a young team, Jesse and Oshman, called Decagon now. And actually, most people didn't realize when they first started, they were not building a customer support company. They knew that they could use LMs to update information. They knew they wanted to do something operational within companies. And they went and interviewed, I'm not kidding, over 100 customers. And across all these different buyers, they spoke to people in customer support, in sales, across ops. And at a certain point, they had an opportunity to build a company that could have been more RPA-oriented and a company that could have been more customer support-oriented. And what did they do? They listened to the customers. They listened to the research and saw where the pull was and where they could have a differentiation in the product. And that's the direction they decided to build the company. And so a lot of times people start with a grand idea, but actually the reality is you have to build to what David said is a specific use case where you deliver value to somebody. And listening to the customer and iterating towards that direction many times can lead to a great result. Well, along those lines, someone asked, how do you decide which company to back when there are a dozen AI startups with good founders doing exactly the same thing? This example said AI customer support, but we're going to use different examples. But in crowded markets where seemingly the demand pool is there and there's great teams chasing it, how do you decide who to back?
I mean, I always ask the founder, whenever I encounter a company in this category, I always ask the founder the same question. So I'll share with this audience, which is, hey, you know there's 12 companies in this space. Why did you decide to start this company? I think if the founder has a compelling reason why they're going to win and why this time is going to be different, then I think you can see the path. But the founder needs to articulate that. And so I think some companies do have a differentiated strategy, and you'll see some categories where there were 12 companies and food delivery. There were a lot of companies. DoorDash won. The unit economics were better. They had a differentiated model. They were starting in the suburbs. There were reasons why DoorDash was going to work and these other companies weren't. If your thesis is, hey, I'm smarter than the other 11, I think that's a lot harder.
Yeah, I actually think that the founder is the truth at the end of the day. So we're backing founders. And I asked the same question, why would you do it knowing what the market looks like? And an answer that is not good is the market is big enough that there could be two of us. I'm like, okay, no, that's not good. But the founder actually is able to explain why, and it's believable. I think that's who you want to go back. And I think sometimes we don't have the time to meet every founder. Ideally, if there's 12 companies, you would meet the 12 founders, and then you can understand what the lay of the land is. But otherwise, you just have to use your pattern recognition from other companies. What state am I backing top 1% person? That's the. It can't be FOMO.
Nothing to add, yeah.
Yeah.
The last thing I'd say is a lot of people talk about product market fit. I talk about founder market fit, which is sometimes does this founder have a unique domain expertise where they get to shortcut the customer research phase of building because they already know the answers they're building for themselves. Sometimes it could be a product that's very prosumer and bottoms up, and the founder's got a secret superpower of distribution. And so a lot of times I ask founders of what is your superpower? And then I try to see if it triangulates what they're trying to build. And so that's a good question as you were thinking about. I'm curious actually, what phase are most people at? Who's a founder in the room? Oh, okay, so the vast majority of the room. Who's at the pre-seed stage? Seed? A? Plus? Okay, mostly early stage. But I think that's a really good question to ask yourself because you don't have to be better at everything. You have to be spiky in one thing. And so self-identifying what you're really good at, it could be talent, it could be distribution, it could be iterating really fast. Matching that to your end market can help a lot. So maybe let's switch over to, I love founder stories or why you invest in certain companies. And someone asked earlier too, what's the most controversial investment or unconventional investment you ever made? And what did you see in the deal to make that decision? We'll start with Alex.
I think controversial is the
What's
key word there. So,
controversial?
well, I'll use a broad definition. But in 2017, we invested in this company called Anduril. We were talking about this backstage, which most people know it's a defense company, counter-drone warfare, now a bunch of other verticals as well. And internally, we back then, today, defense tech is more in vogue, I'd say. It's, you have people are talking about the Gundo in LA, where everyone's trying to start a defense company. And it's much more popular, I think, given geopolitical realities. People understand the need for, I think, Silicon Valley to be involved in defense. But in 2017, that wasn't true. You had Google actually exiting their DARPA contract, I think it was, because of an employee revolt internally. So really, defense was, something you didn't touch, and most people didn't want to work at a defense company. And so we were the first outside money in Anduril in 2017. And actually, the internal discussion was, this is so controversial, I think there's a 10% chance the firm gets protested, and then no one will ever work with us again, and we can never do deals again. And so somebody voted a rare 0 on that deal because they thought it's an existential threat to the fund. And we've never had a vote like that ever in APC, where we thought actually there was some huge blow-up risk to doing it. And so that's probably the most controversial one. And it's funny today to see the change. Andreessen now has a effectively defense fund, and I think Andreessen is the pinnacle of marketing, so it's got to be a real thing now. And it's just funny to me to see that people are advertising investing in defense when we were literally which newspaper is this going to be on the front of, and how bad is that going to be for us? So that was it.
Well, it sounds like that one has really paid off, so congratulations.
It worked out very well, but it was not obvious at the time.
Yeah, we don't have a vote system, so I don't know if everything, if Peshman and I don't agree, maybe it's controversial just by that statement. But, we are very founder-led, so meaning we really try to spend a lot of time with the founders and back the founder. So when we started the fund, we backed this guy called Helmi El-Tuki. He did his PhD with me, and I knew he was very, very smart. And, we backed a biotech company. I think we were Fund 1, and our LPs were, what are you doing backing a biotech company? For those fund managers that have Fund 1, you're trying to prove everything goes to thesis. So anyway, so we still did it. I'm not a biologist, but now I know enough about biotech that I can be dangerous. So that would be maybe controversial, at least to our LPs at the time. I would say it was also controversial when we invested in the Series B of DoorDash. We're a $50 million fund, and that Series B was 600, and the LPs were like, what are you doing? But when you have a good company, that's where you should do it. So anyway, so I think we've broken a lot of LP rules. More than partnership rules.
Yeah, I have some humility on this. I think all three of you are probably more audacious. Seed investors are intrinsically more audacious than growth investors, so I don't think I've done anything quite as contrarian as investing in Anduril in 2017, so congrats on that. I think as a growth investor, the thing that you do that's audacious is you pay the big prices, right? It's a competitive market out there. And so 2 examples stand out in my mind, which is I remember when we invested in Marqeta, a $2 billion valuation. We invested in Databricks. Also, I think it was a $2.6 billion valuation. And this was 2018 when those were really high valuations. Yeah. And I distinctly remember getting a call and someone being, are you guys insane? What are you guys doing? And obviously, we've all seen, the last 6 years, prices have only gotten higher, and these companies compounded, and one is public, one is, very late stage. But I think that as a growth investor, the audacious thing you have to do is sort of believe. And I think that all growth stage investments come down to some belief about what the 10-year compounded growth rate is. How is this going to be growing in 7 years, right? And if you get that right, then you can make an audacious bet. And if you get that wrong, you're going to look like an idiot. And so I just think that tension is something that we think about a lot. And I think that's also a tension that is useful for founders to think about, because as you think 7 years out, what is the growth rate going to be? That also affects how you should capitalize the business, how you should run the business, what are the operating margins of the business. The way that you run the business is different.
I saw a lot of questions in here about how do you run your firm, and being an early stage investor, you have to be unconventional and right. That is actually how you make the real venture returns. And I'll tell one little story. Back when I was a lonely little 23-year-old, I was like, oh man, I'm so excited about this mobile transition. It kind of, now it feels bigger, but kind of feels like the AI platform shift right now. It's like, I'm going to find every mobile company out there. And I had the wrong thesis that led me to the right idea, which is I was like, enterprise mobile is going to be a thing. And when I met 100 companies, like, wow, this is not going to be a thing because Workday is just going to add a mobile app and Salesforce is going to add a mobile app and it's just a platform extension. But then I was like, wait, who doesn't have Salesforce or Workday? People who are deskless workers. And then I spent all my time chasing people in weird vertical markets. And that's actually how I found ServiceTitan back in 2013. It was 2 Armenian young founders who were first kids in their families go to college, building an app for their plumbing dads. And whoever thought when you brought a plumbing software company into your partnership in 2013 that that would ever get approved? But that was the reality. It was quirky, it was weird, it was an opportunity for a new system of record. And the consensus back in the day was that vertical markets were too small for software. Not enough buyers, and the spend was low because they didn't have mobile. There was no way for them while they were on the go to actually use software. And the markets multiplied in big part due to fintech and a lot of Marketo is a big contributor, actually. And so now, I mean, it's kind of a fun time. Like, ServiceTitan is probably going to be the mega IPO for the end of this year. But back in the day, it had to be weird. And so I would encourage a lot of people in the room, it's okay to be weird. In fact, we like it when you're weird, because we are weird too. And to the question earlier of like, hey, how do you decide between 12 founders in a room? Actually, we really like it when someone goes in an opposite path. Awesome. All right. Let's see. We got a couple more minutes left. Let me try to hit a couple more of these questions. Okay. So I'm curious. A lot of the questions around how do VC firms work and make decisions, and that's always a big question I get a lot too. So maybe let's go down. We'll start with David. How do you decide to approve a deal?
Yeah, so Sequoia is a partnership, and so we sit around. I think it actually is a bit of the stereotype. What people think happens at Silicon Valley actually happens at Sequoia. And so you have a bunch of people sitting around a table. Often the founder will come in on Monday morning. They'll present their idea, and we'll sit around. We'll have a memo that will go out on the Friday before the weekend. So we all read the materials ahead of the pitch. We listen to the pitch, and then we'll have a discussion around the company, and we'll have a vote on the company. And we try to have different opinions. We try to debate these things out. And I think one thing that maybe is underappreciated is if you have 1 or 2 people who are really convicted in a company, that is often enough to get over the line. So it's not a consensus-driven model. It's not the case that everyone has to like the company. And so I think it's about having a few people who are passionate, who have conviction, who see the vision that the founder sees, and it's their job to educate the partnership around what that looks like so that we can get conviction to move forward.
Yeah, we are, it used to be when we started Pair, both Pashman and I had to say yes. And, when I'm a little data-driven person, so I'm always looking back. And one of the things I've observed that our biggest misses was when one of us wanted to do it and the other one did not want to do it. So we switched, and we're now totally conviction. If somebody's pounding the table, especially at seed, that's when you should do it. In fact, if you have a big partnership, there's enough people around the table, you'll never do it because there's always a reason not to do it or 100 reasons not to do it. And it's almost like, what do you need to believe for it to actually be something? So we've changed to conviction-based. And even now that we have more partners, there's no more than 4 people in the room when we make that decision because, again, I believe that more people in the room means less risk and less creativity.
I'll say one aside, and then I'll just talk about how it works at APC. But if you're interested, there's this good book that was written in the 90s, 1999, called E-Boys, where it's like this really cool piece of lore and venture that a lot of people don't know about, where, I forget, New York Times reporter, some magazine, some newspaper, was able to sit in the benchmark partner meetings in like 1999 to 2001. And really cool book to read. You can see the discussions they have, how they made their decisions. Like, it's pretty cool. I mean, I don't even know how that happened, but it's like a unique snapshot we got in time. She does kind of point to, you'll see it was a lot crazier back then. Like eBay went public in 12 months after founding, like stuff that doesn't happen today. But at APC, we have a 7-person there's process where you meet with us, we'll do diligence. That diligence is shared with the whole team. We do calls every 2 days to sync up on every deal that's live. Everything culminates in a final presentation, and then we all vote. There's 7 people on the investment committee. You need 4 of the 7. And then every partner gets 1 silver bullet per fund if they want. And those like almost uniformly always perform the worst. So like people have actually stopped using them. And it's very rare things die at the vote stage. They usually die before, where the diligence didn't make sense or the questions weren't answered, and the consensus became, okay, this is not a good opportunity. So it gives you a little window that like, you can have one person often push a deal through, especially if you have a lot of clout. But you do, at APC anyway, have to get everybody else sort of convinced somewhat too. But people do defer to others' judgment, especially in areas they have expertise in.
Well, so we're a 3-person partnership and believe very much in the conviction model. So while we all believe we have to know about the company, meet the founder, spend time, we believe in a single trigger because we think at the early stage, outliers would generate great returns. And so we want controversial deals. And from my time at Bessemer and actually at Andreessen too, it was the most controversial deal that ended up being typically the highest returners. All right, super last question, rapid fire. What is your favorite product that most people don't know about it? I'm going to start with David.
This is one that people know about, but I'm still going to pump it up anyways. And I'm not an investor in this company. I'm obsessed with Perplexity. I use Perplexity at least 20 times per day. I think it's a fantastic product, and I think the team behind that. It's an example of people think, oh, this is such a simple thing, and yet behind the hood, and I think this is what product is in AI, it's so delightful, and they understand the user so well. And so for people who haven't studied Perplexity, go check out Perplexity and just study how they've designed that product, because I think it's really brilliant.
Okay, it has to be a product that people don't know, right?
Generally don't know.
Yeah,
As David already broke my rule in the first
People know
answer.
about Perplexity. I was saying backstage that my favorite product is my little heater that I, take around with me around the house because it allows me to have my own microclimate. So that's my product. But, I've been using, I'm putting a plug for one of my companies that is, maybe people don't know, but it's called Clarify, and it's one of these meeting transcribers, but there's a tooling around it that allows us to converse around the meeting, and that has changed the way we run our company. So I'm putting a plug for them.
Okay, I'll give one everyone kind of knows about that I spend all my time on now. I love Polymarket. It's like the best. I have views on the most esoteric things happening now, which is like really funny. News event comes up, you're like, who did they select for Treasury? And then the one probably you haven't heard of, I don't know, this is a weird one, but I like this thing called Fight Camp, if anyone's ever tried it. It's like Peloton, but for boxing and kickboxing. It's like good workout. You get your sort of like aggression out a little bit.
I do not want to be on the other side of a deal with you. That sounds terrifying. All right, so Mark kind of took mine. I was actually going to say granola because I love their transcription and being able to talk to their chatbot to understand, everything. And
You gotta try my company.
All right, I gotta try yours too. But I'll throw in a second one, which is I actually love Blockit, which many people have already probably seen. It's like a calendaring AI assistant. But I have not hired an EA, and I probably take 30 meetings a week. And so check it out. All right, well, big round of applause for everyone on the panel. Thank you so much.
Just 1 second. Is the microphone working?
I think you can just put it down.
Test.
With
Hello?
you. There you go.
Yep. Hey, folks. Folks are outside. You want to corral them in and leave the door open, maybe? All right. This is an exciting one. I'll let Tejas sort of introduce Freddie. So Tejas is the co-founder and co-CEO of High Touch. They use data and AI to optimize marketing. And Freddie is the co-founder and a former COO of Okta, an amazing public company. I'll let Tejas explain why he has a plant with him.
Yeah, so I heard that the next group has like furniture and a couple ferns maybe. So we thought we have to bring a treat of our own for the crowd.
How's everyone doing today? You're going to have to do better than that. It's the afternoon. They didn't give us any coffee back there. How's everyone doing? Dude, I don't know. All right, we'll see.
All right. Do you want to intro yourself a little bit, Freddie?
Sure. Nice to see you all. I can't see anything up here, of course, with the lights, but it's nice to be here with you all. My name is Frederic Kerrest. I'm the Vice Chairman and former Chief Operating Officer, co-founder of a public enterprise software called Okta. I'm an enterprise software entrepreneur, an investor. I love building companies. I love what you all are doing here. I know you're all going through some good times, bad times, tough times, and everything else. So we've got a couple of prepared questions, but I'm hoping the audience will have some good ones and that we can talk about some interesting things today. So,
all right. And do you want to tell us a little bit about yourself personally? I know Okta probably took over your whole life over the last 10 years, but
15, but who's counting? I was even tall. I know it's hard to believe. I was even taller and better looking before we started Okta, and it's not just these chairs. Yeah, I'm married. I have 3 amazing kids. I live here in the Bay Area, yeah, just happy to be here. So,
all right. So tell us a little bit about when you founded Okta with Todd. What was the kind of like aha moment that made you think, okay, I'm going to start a company? What was the initial thesis or hypothesis? It was in 2008, 2009. How was that?
So my background is in computer science. I got a computer science degree a long time ago. I think one of the previous panelists said she was one of the oldest people in the room. I think I might also qualify. I wrote enterprise software for a while. I joined a company called Salesforce.com in 2002. Right next door when there's about 100 people there, and I was there for about 5 years. The company went public, and that's where I met Todd. And as enterprise software folks, we spent a lot of time previously in a client-server world and then in a kind of 3-tier architecture world. And Todd and I had a front row seat to Salesforce and going public. The company had $50 million of revenue when I joined. It was about $1 billion when I left. I think they're going to do $38 billion this year. So this was quite a while ago, but it seemed like a new thing. People may actually subscribe to enterprise software over the internet. And so the thesis for the company was, look, enterprise IT doesn't throw anything away. What they do is they buy new things and they glue them on the front. And so we thought that there would be a need for an integration layer for all this modern cloud architecture to plug into all the existing IT infrastructure that was there. And and that was kind of the thesis. We pivoted. We can talk about that. We almost died 10 times, like maybe some of you. So, yeah, it was quite a ride.
And what did it take to eventually make you realize, all right, I'm going to start the company? And was there a specific moment? Was there a specific realization? Was it an entrepreneurial itch that you just had, or?
Yeah, I think, like all the entrepreneurs in the room, you feel like you need to go build something. You want to found something important. You want to do something important. I spent a lot of time in enterprise infrastructure. I'd been pretty close to the early days at Salesforce, but I hadn't founded the company myself, obviously. And, it seemed like there was going to be a big change, and we wanted to be part of that change. So the first thesis we had for the company was actually different than what we ended up doing. It was more about some system management software, and we went out and talked to 50 CIOs, VPs of IT, directors of IT, frankly, anyone who would answer the phone, and asked them about what we were doing. And they said, well, that's interesting, but really there's this other problem, and it's about users, and it's about access, and it's just starting. And that was kind of the genesis behind it. Obviously, when you're starting a company, there's 2 of us. Today, the company has about 6,000 employees. It's about $2.5 billion of revenue. There's about 20,000 enterprise customers. It's been a public company for 7 years, so you don't kind of foresee that. But I think that when you get attached to some of these trends early on, if it's something you really care a lot about, there's always going to be great ways to find a way to make a difference and build a foundational company there. So,
what did the original product actually do? What's a material example of what you imagined the original Okta to do?
Yeah, the original product did not do anything really very well. The first customer that I was, the sales guy, and so I closed the first 20 customers or whatever. The first customer signed a $400 PO for 25 seats for 3 months, and they were like, well, the product doesn't work. And I was like, yeah, but it'll work. And then 3 months went by, and it kind of didn't work anyway. And I was like, you owe us $400. And they're like, well, it still doesn't work. But I'd learned that trick from Brian Halligan at HubSpot, who used to have, they started before we did in the mid-2000s, and he used to have a credit card machine, like a swipe machine. And he would go over to customers and be like, okay, I need your credit card. And they're like, it doesn't work. And he's like, yeah, but it's going to work. And if you want to use it when it does work, I need your credit card now. And that was a pretty effective sales technique. In fact, on the back of that $400 invoice and a little pipeline, we raised our Series A. So there you go. Things haven't changed that much.
Wow. So it was a Series A.
Yeah, but these are different times. We should talk about that. So
yeah, how does fundraising compare?
Yeah, fundraising's pretty different now. For all of those of you who are able to raise financing, there's a lot more capital in the system. You'd be lucky to get 10, 12 times forward 12 months on a valuation, and you actually needed a business model to prove that you could get there, which it seems like is a little bit different these days. But yeah, so we were Andreessen Horowitz's first investment ever in their first fund ever. And Ben Horowitz is still on my board to this day, 14 years later. So it's been entertaining.
So would you say the investment came first or the product market fit came first?
We raised a seed round, what you would all call pre-seed, which I don't know how that makes any sense. The seed is the thing that goes in the ground. So what's the pre-seed? The soil. So there was no soil. It was seed. And by the way, there was no seed firms or funds. It was you went and talked to your parents and, some dentists as we used to do. And so we raised $1 million on a 2-page, glossy PDF. And I'd spent a little bit of time in venture capital when I was in business school, just enough to know that entrepreneurs are terrible at promising and delivering. So what I did was I said, hey, we're going to put a really low bar, and that way we can achieve it faster than we say we will. And so Mark Andreessen and Ben Horowitz were part of that seed round, and we did exactly that. We said it's going to take us a year. We're going to do this. And then we went and saw them 6 months later and had signed that one customer and had a little pipeline and built a little product. And that was the beginning. We ended up raising our Series A from Andreessen Horowitz, and the rest is history. So. And
that was for the login Okta, or that was for the integration Okta?
Single sign-on product that basically you could single sign on into Salesforce and Google. And I don't think the Google one worked really well. The Google APIs were not tremendous back then. So yeah, I didn't do much more than that. You could try and create users and delete them, but it may or may not work. I remember this. We used it all the time, and I'd be like,
it works today, though, right?
My user just got deleted. Sometimes, yeah. Sometimes.
Cool. So when you started Okta, you had a different thesis for the company. You went out and talked to a bunch of customers, and things changed, right? You got some feedback. You heard that this is a big opportunity. Was it super clear that the single sign-on login stuff is what you should pivot to, or how did you parse these calls?
Yeah, that was clear. What was harder was to actually find the right product market fit. The problem with media, and I empathize and sympathize with all the founders in the room, because media is very barbell. They're going to tell two kinds of stories. Either the story of Jeff Bezos, who's building rockets and going to the moon and whatever, or the stories of everyone lost $1 billion and they went to jail. But they don't talk about what happens most days to most entrepreneurs, which is you get up really early and you go to work for a long time, and then you try and build the company, and you do the same thing the next day, usually 7 days a week. And so we went through that, and all good companies, by the way, have almost died 10 times. And we almost did, a bunch of times. And, I think you just have to have, grit and perseverance and resilience. And we had times where it's like, yeah, the forecast looked like that, but the actuals went like that. And people were like, we're going to quit. And, you might not be able to raise another round of financing. Our Series B, we went through the Series B Valley of Death. Where it's like, okay, on the A, you can sell on a promise. On a B, you have some early traction. But on a C, you need to be able to drop a gas bag on it and have it just blow up and the whole thing take off. And we were not there. And so through the Series B, things got really tough. Very contentious with investors. I got thrown out of 2 board meetings in a row. People are like, you got thrown out of the same board meeting twice? I'm like, no. 2 board meetings, I got thrown out of both of them, just because things were not going well. And so we were having arguments, and I thought I knew better, and the investors were like, you don't know anything, and you're like, well, I'm building the company. And I remember going home and telling my now wife, who, we were married at the time, but she's a doctor, so she was in resident doing night call, which is when you work only at nights. So it's a waste of a month. I mean, you don't see him for a month. And I remember coming home being like, she's like, how'd work go today? I was like, I didn't go that well. She's like, well, what happened? It's like, well, I kind of got thrown out of the board meeting again. She's like, okay, well, are they going to fire you? I was like, yeah, I guess, I might get fired from my own company. She's like, okay, well, can you get another job? And I was like, whoa. Where's the support? Where's the love? What do you mean, can I get another job? You're the doctor. What? And she's like, okay, I got to go to bed now. And I'm like, what? So... yeah, no. It was fun times. It was fun times.
What was the biggest learning from that Series B to Series C stage where,
Yeah, actually, a really good one, which was, I remember Ben and Anil Bushri, who is the CEO of Workday, who was a partner at Greylock at the time, and they sat us both down, me and Todd, and they're like, hey, here's the problem. Who's the head of sales? I was like, well, it's me. And they're like, yeah, but you're also the CFO and the general counsel and all these other things. And who's the head of engineering? Todd was like, well, that's me. And they're like, yeah, well, the problem is you're also the CEO and all these other things. So what you guys need to do is get a dedicated head of engineering who is not you and a dedicated head of sales who is not you either. And people who actually will know how to build that engine the way it needs to be built next. And I was like, well, it's insulting, but you're like, I don't know, we might run out of money, which would be even more insulting. So, okay. And that was actually a big turning point, was realizing that it was the first time I realized that the way you succeed as a scaling entrepreneur is actually to hire people who are better than you are at all these other critical jobs. And then I actually spent the next 10 years trying to hire the best people I could and get out of all my jobs. And I was like, if I could, there's always plenty of stuff to do, so that's not a problem. But it's if I can find someone who is the best in the world at, we hired an amazing CFO, we hired an amazing general counsel, we hired an amazing head of people, all these people where you're like, wow, they're doing the job 10 times better than I did, and now I can focus on these other things because there's always more things to do. That was a big insight. And in late 2011, early 2012, we finally hit a quarter, which was a big deal. And we released a bunch of features, and we had just brought on the first head of sales and the first head of engineering who were not the founders. And that was a big aha moment, and something I always remembered. It was basically my job as a founder is to hire, attract, retain, develop amazing leaders, give them everything they need, block down all the barriers, and then get out of the way. And the more you can do that, the better off you'll be. And plenty of times, I'm an angel investor in about 100 private enterprise software companies now. I spend a lot of time with amazing people like Tejas when he answered my phone call, which isn't often, but that's okay. And the number one thing is they become bottlenecks, and they become bottlenecks because the growth of either the company or the function or whatever is limited by their capacity, both in terms of what they can actually do, but also how much time they have, both of which are limited. And both of which are constrained, and if you're doing well, are going to get more limited and more constrained.
At what point do you think your job as a founder pivots, right, from the doing everything phase to hiring is one of the most important top tasks? A lot of people in the audience are probably in the earlier stages of the companies with the Soil Summit we're at.
The Soil Summit, that's right. Soil and seed, just to be clear. Well, I mean, you do everything for a long time. You still have to lead by example. It doesn't matter. Like you still, even when you have thousands of employees, you can't ask anyone to do something you wouldn't be willing to do yourself. And so you can't ask someone to get on a flight and fly around the world to do a deal if you're not willing to do that yourself. And you have to pick and choose your spots, of course, but leadership, I mean, that's what leadership is about. So yeah, for sure, we did everything. And when you realize, like, assuming you have capital, which is like less of a constraint today than it has been, I'm sure there's some people in the audience being like, that's screwed up because I can't raise any money. I get it, okay. But in general, there's more capital in the system today. And so if you find yourself being like, hey, I'm overloaded in this one functional area, like customer support, but I don't have the time to write the job spec to hire that person, that's exactly when you need to stop and write the job spec, because you're probably like 3 months too late already. And I found myself in that position time and time again. And then slowly you get like, you start to see the patterns and be like, ooh, time out. I think in like 2 months I'm gonna need this, so let's go start looking for it now. But that's a big one, is like, if you don't think you have time to write the job spec, that's exactly what you need to be doing tomorrow.
Biggest hiring mistakes at the early stage and at the late stage?
Oh man, we made all the hiring mistakes.
Or tips?
I don't think we have enough time. Yeah. I don't know. What did he said? What? Yeah, 20-point checklist. Like, I don't know. That sounds pretty extreme. I don't think I had any 20-point checklists. One thing is like, you're gonna hire a bunch of people where you don't know what great looks like. Okay. So, for example, you're trying to hire your first head of enterprise sales. Okay, you know what even a really bad head of enterprise sales is good at? Selling themselves. And you're not gonna know the difference. And so getting people who do know what that looks like, whether they're investors or advisors or friends of yours, or like, cold calling people on LinkedIn or whatever, and saying, hey, when I get to, first of all, there's two things you should do. First of all, the job spec, okay? You should look at that and read it carefully and like design it with someone who knows what you're looking for. Because there's 5 different kinds or 10 different kinds of enterprise go-to-market models. And like, they're not all the same. And so people will be like, oh, I hired this guy or gal because she came from so-and-so. You're like, that's a completely different business model than your business model. And they're like, shit. And you're like, yeah, shit, because that's an 18-month mistake, right? 6 months to fire the person, 6 months to recruit the new person, 6 months to get them up and ramped, at which point, like, your money's gone. So, I would say, like, be very careful on, like, how you're selecting leaders, and then get someone who knows what great looks like to help you interview these people. The other thing I would just say is, like, remember that your network is great, but also you should be recruiting all the time. I mean, none of you have heavy machinery or factories, which means that 70 cents of every dollar you spend goes on how you hire, attract, retain, develop, and grow the best people in the world. People are your number one cost. So if you're not spending 1 to 2 hours every day, calendared in the morning on your calendar, recruiting, I think that's a mistake. And you'd have to make the argument to me on why you're not doing that, because that's like the most important thing you should be doing at all times. If you have, as soon as you have 4 employees, I would hire an in-house recruiter. Assuming that your plan has you hiring 5 or 10 more people this year, it's a no-brainer. Because, you're like, I'm hiring an outsourced recruiter. Yeah, and they're working for 10 other people, and the squeaky wheel is going to get the grease, and that person is going to have tried to place someone 7 different places and got rejected, and then you're the 8th, but you don't know that. And they don't know the story like you do, and they don't know how things are moving. So, like, our 4th hire was an in-house recruiter, and like that was one of the smartest things we ever did. I give credit to that one, goes to my co-founder, who was like, absolutely. And I'm like, this is ridiculous. And he was totally right.
So these tips are really helpful once you've established a product market fit. But you all went through a pivot.
Even at 4 people, we did not have product market fit. No.
So what tips do you have on the journey?
Right? You guys all got that, right? Okay.
What tips do you have on the journey of pivoting? Like, if you were to think back about your process in pivoting, it's a common thing that a lot of startups go through.
Yeah. Well, I think it varies for consumer and enterprise. For consumer, it's like clear what the traction looked like. Enterprise, you can trick yourself into thinking that you can build a business by like getting into that cycle where you're just being like, I'm convinced because I've created some opportunities in my pipeline, and then I'm convinced because I closed a couple customers, and then I'm convinced because of the next thing. And you should always be stress testing that, being like, do we really have something that's going to scale? And I know people are like, well, I'm going to build a platform, infrastructure, this, that. That's fine. I'm a big fan of building becoming a monopolist in a small market with a lot of adjacencies. So pick something that is very clear, and it's like, oh, I can drive a wedge right through that thing. I can become the monopolist, and then there's a lot of things that I can do next to it. Not the monopolist, but the leading vendor, right? Tactically, you need to think about that. And so, number one. Number two, you're going to talk to all your peers. You're going to have a peer group. You're going to have a Slack channel. You guys are going to have dinner. You're going to talk to them. Oh, what are your numbers like? What are my numbers like? This, that, the other. That's all fine and good. But remember, like, no two businesses are the same. So just because their go-to-market motion looks like one thing doesn't mean that yours should look the same. And it's like, oh, well, they went, 5, 10, 50, so I should too. It's like, well, maybe not. They've been doing 10K deals. You're trying to do 250K deals. I mean, it's totally different. And it's like, and then people are like, oh, I was just talking to a founder 2 days ago. Oh, I think we should go with a vertical strategy. I'm like, what does that even mean to you? He's like, well, we closed one retailer, so we should close another. I'm like, well, that's true anyway, but that has nothing to do with having a vertical strategy. And why should you have because I was talking to some CRO at another company, and he's got one. I'm like, well, these are like the worst, reasons I could possibly think of. So like, let's talk about your business and like, what are the industries and what are the things you need to do? And so I understand that when you don't have all the answers, you're grappling. And so you hear something, you're like, that's the answer. And then you hear another one, you're like, that's the answer. And it's like, no, those probably are not the answers. Those are the answers for those people. So you should always be listening and like trying to take the input, but understand that like, I understand you have imperfect information. I got it. But guess what? Everyone always has imperfect information, number one. Number two, you have more perfect information about your business than anyone else does, for sure. So it's great to listen to all the inputs, but at the end of the day, like, you should be like, I think this is the strategy. And you need to have a strategy and a thesis, and then prove it or disprove it, right? Don't waffle. You need to have conviction. And then you need to say, hey, we're going to do this for 6 months, and if this is not working, we're going to sit down and say why, and then we're going to look at it. But you can't like waffle every time like the wind changes, and it's like, oh, I just read a blog post. Shit, we're actually going to go to a go-to-market PLG motion. And you're like, what are you talking about? Like, the person wrote a blog post because they can't get a job, So, yeah.
No, I think it's a really good point around like seeking disvalidation of some of your ideas and theses. Like the worst thing I see is when early stage founders are just like super high conviction in some random idea which they started with instead of like iterating and moving to the next one. A final question for you. What kind of tip would you give to founders who are just starting to fundraise for the first time? How would you suggest that they think about investors? And
one of the common mistakes, I talk to founders all the time about fundraising. We help with strategic fundraising conversations all the time, literally every day. And like one of the big mistakes that people who have not seen the movie start with are like, oh, what are the firms I should talk to? Okay, so what you have to realize is that investors are not firms. They're random collections of people who got together for the purpose of collecting other money from other people to disperse it to you. Okay, so you had 4 different venture capitalists up here. They're all different. And some of them have, specific enterprise or consumer, or I do defense, or I do biotech, or I do whatever. I do at this stage, I do at this thing. So you need to identify the people who you think are going to, first of all, understand what you're talking about, like what the story is and why it could be big, and B, that are relatable, like that you're like, okay, this is someone that I think that if I go and I talk to them, we can have a good conversation and I can understand and explain to them what I'm trying to do and why I'm trying to do that. And then obviously that like if I'm fortunate enough to get a term sheet from them and they join my board, that they're going to be able to provide value add. And one of the biggest things I see is like, I understand there's a lot of it. I understand if you go to ChatGPT and say, give me the best enterprise, it's going to give you some matrix of like 500. I got it. Okay. However, you still have a vision and an idea of what you're trying to do and where you're trying to go. There's probably 3 or 5 companies that you're like, ooh, I like what they're doing. I'd like to emulate what they're doing. They're 3 or 5 years ahead of me. Look at who's on their board and who's providing value. Look at who's actually writing things that seem to make sense. Talk to your friends. Like, who do they like and who do they not like? The worst thing you could do is get like a bunch of brand names on your board where it's people who like don't pay attention, are overboarded, don't have enough subject matter expertise in what you're doing, or like are doing too much pattern matching, or even worse than that, if two of them don't like each other, they're going to get fights in your board meeting that have nothing to do with you. Not that that happened to me, but maybe it did. Who knows? And so, like, just being really thoughtful. I think Kristina said it the best. It was the last thing I heard before I had to go backstage and put on the Michael Jackson microphone, which was, it's harder. It's true. It is harder to divorce your investors than it is your spouse. Okay? It is impossible. Partner swapping inside a firm and changing out the firm are like anathema. You are over. Show's over. Company's over. It's never going to happen. So, like, these are the most important decisions you can make. And remember, whatever round you're doing, your pre-seed, your seed, even your Series A or whatever, there's going to be hopefully 3 more rounds. So whatever 3% or 5% increase in term sheet valuation you're getting from the investor that you don't like as opposed to the one you're going to like, that's going to impact you for 2% ownership, that thing also is going to get diluted 4 times. And it's going to end up being 30 basis points at the end of the day. And what you're trying to do is get a very small piece of a very large pie. When we went public, I owned, a lot less than I did when we started the company when there was 2 of us. But guess what? It was worth a lot more than 0, which is what it was when we started the company. So that's the goal of what you're trying to do. And you want to make sure that, like, for that 30 basis point delta, you got someone that you actually wanted to show up on your board and help you and was like the right fit for your company, not a name brand of someone else that didn't really have that impact. So,
all right.
Are there no questions from the audience? You didn't even look at your phone.
There are some questions.
He gave him a bogus email, so the questions are going somewhere else. You just raise your hand.
How do you hire
anyway.
an A team of co-founders before the funding? How do you think about recruiting and picking co-founders?
Picking co-founders. Well, Todd and I dated, and then we actually went to dinner with his wife and my fiance and had our significant others kind of interview. I didn't realize that was what was happening. I was like, oh, sure, I'll go to dinner with them. Hey, baby, we should go to dinner. Oh, yeah, great, sounds good. We show up at dinner, and I'm like, oh, shit, actually, I understand what's happening now. So I was trying to, like, tell her under the table, but she's a doctor, and she's like, oh, what nice people. I'm like, no. Evaluate whether or not I should be working with this guy. That's what we're supposed to be doing here. We actually also had, like, he gave me a reference list of people, of executives from Salesforce and before, who he was like, you can call these people. I looked at the list. I was like, you can pretty much call those people about me too. So that was good. So there's a bunch of things in common. One thing that worked out really well was we were not best friends. And I think that's still true today, 15 years later. We're great business partners. It's been an amazing partnership. We get along great, but, like, we're not best friends. We don't spend time together on the weekend. His kids are a little bit older. They do different things than my kids. And that actually has worked out really well because it's not emotional. And in fact, I started another company in 2017, a neurotherapeutics company that Genentech Roche just bought with 2 other people, one of whom was, like, one of my best friends. And I had to sit him down. And he was also an entrepreneur. He was also a professor. And I said, hey, I think this could actually be a big problem. We need to talk about this ahead of time because of all the train wreck stories and because of my experience at Okta. Like, this could get really hard. And he's like, cool. So we actually had that discussion and worked out okay. But I think I was more mature. I think when I was younger, if Todd and I were best friends, it would have been way more emotional. And it's super hard as it is, as you all know. But, like, you want to stack the odds as much as you can in your favor. So at least being able to have unemotional, objective disagreements, I think is super, and then not, like, drag it into friendship is a super valuable thing. So.
All right. Well,
anything else? That's it? Come on.
All right. There's one more question. That's
there
good.
You go. All right. Thanks.
I'll give you a rapid fire on this one because we're over time.
Okay.
You guys were experienced leaders before starting at Okta, experienced at Salesforce and whatnot. How would you think about fundraising without that? For the younger founders out here?
I think the biggest thing is, like, storytelling. In fact, when we went to raise our seed round, we were rejected by, like, 20 firms, okay? They're all like, yeah, nope. Yeah, oh, it's a great idea. No, we won't invest. By the way, there's 1,000 ways to say no, and they all mean the same thing, by the way. No, right? So it's like, oh, my partners are out of town. Oh, the other thing. Oh, well, we're right in the middle of fundraising. Oh, it doesn't matter. You got the picture. It's all no. Okay, so we got like 25 of those. And we were driving down to Silicon Valley again. And we were right by the airport. And I remember Todd looking at me and being like, we might never fucking raise money for this company. And I was like, that is the wrong attitude. I was like, so what? And we were on our way to see Mark and Ben. And I was like, okay, so what is the problem? What do you think the problem is? He's like, I don't know. And we're getting there. And I was like, you know what? Our deck sucks. Like, you're not an artist. I'm not an artist. The thing looks terrible. It looks like we pulled out a bunch of like Microsoft icon things, which is exactly what we did. And like, he's like, okay, well, what do you suggest? I was like, let's just like tell the story. And so we walked in, and they didn't have a projector anyway, conveniently, because it was like early days and they barely had a table. And they're like, so you guys want to throw us a deck? And I was like, no. And they're like, oh, well, that's great because we don't have a projector. And I was like, well, perfect. So we're going to tell you a story. And we told them the story. And it was a true story. It was like, you know, what we'd seen and our experience in enterprise software and how we'd seen this revolution starting to happen at Salesforce. And we believed that this was going to be much bigger and all these other things. And they're like, yeah, okay, this sounds interesting. And we walked out and Todd was like, oh my God. And I was like, yeah, that was unbelievable. He's like, we should never use a deck. I was like, that is the wrong answer, okay? Do not extrapolate that line out. However, it is very true. Like, the takeaway is right. Like, the story matters way more than the slides, okay? I talk to founders all the time. I'm always trying to help them out. And, like, what I care about now in my old age is about the entrepreneur. Like, why you're doing what you're doing and why you give a shit. And you're all very smart, very talented. Why are you going to spend the next 10 years of your life doing this? And you can tell really quickly. And when we were busy at Okta and we were public, and then there was a pandemic, and then I started a biotech company, and it was like I'd be on an airplane somewhere between Germany and Australia, and one of my friends would be like, hey, you should write a seed check into this company. And I'd be like, I don't even have time to look at it. Okay, fine. And then I stopped doing that because I really want to invest in the entrepreneur. And so I want to meet the entrepreneur. And the story they'll tell me, it's like businesses are not written on a spreadsheet. It doesn't matter what you extrapolate out your revenues to be in year 5 when you have zero revenue. It's like, well, it could be 200 million, could be $1 billion, could be zero. Like, you have no idea. It doesn't really matter. And so I started looking at these pitch decks, and I'd be like, they have no idea. And it's okay. I had no idea either. I did it also. But like, the story of, what you're doing and why you're doing it and why you care and why you're going to spend your time doing this is like, obviously you're doing it in a big market. Obviously 1,000 things could go wrong. Obviously 1,000 things could go right. But like, what the conviction is that you have and what you're trying to do, like, that's the thing. And that's the thing in entrepreneurship and innovation anyway, right? The things that are changed at such dramatic levels are changed by the people who have the conviction and hear it 25 times say no, or 100 times, no, stupid, no, stupid. Okay, I'm not saying you should make that total catnip with like blinders on, but kind of, right? Because if you believe in what you're doing, you will find someone else who believes. If not, like, okay, maybe you need a new idea. I got that. But I'm just saying, like, that is the thing that matters. And so don't worry if you get told no 1,000,000 times. It's happened to all of us. No one will talk about it, but I'm here to tell you it's happened to everyone. And that's just part of the program. And a lot of times these decisions will be made for reasons that have nothing to do with you. It'll be just a bad day at the venture capital firm because a company just went bankrupt over the weekend, so they all walk in a bad mood. And your pitch might be the perfect pitch. And they're like, no! And you're like, fuck, dude, I thought this was teed up. And it's like, it was, right until like the senior partner wrapped his Maserati around a telephone pole on Saturday morning with a woman in the car who wasn't his wife, okay? And like, that has nothing to do with you, and that may or may not be a true story, by the way, and that has nothing to do with you, and it will impact your ability to raise money in the partner meeting on Monday morning, okay? So just understand that like, everyone's human, and there's a lot going on, but I wish you all the best of luck. If there's anything I can do to help you, please don't hesitate to let me know. All right?
All right.
Thank you all very much. Nice job, dude.
Thank you.
All right, we're going to get started again in 1 minute if folks want to come in and take their seats.
Sorry for the delay. I got up here a little bit late. My Maserati was just getting out of the garage, so just had to deal with that for a little bit. So
challenges.
Yeah. But can't imagine anybody would have any context on that situation. So everything you just heard was a total lie about fundraising. So I'm going to give you the real truth of when you should actually give up if you get no's constantly. So we'll go through that.
All right, well, on that note, let's get started. Welcome to Between Two Founders. I'm Jeff Seibert. I'm the founder and CEO of Digits. We've spent the past 6 years building the world's first AI-native accounting platform. We work with hundreds of top startups, including a bunch of great founders in the room with us, so thank you all. Digits is the third venture-backed company I've started. I was previously founder and CEO of Crashlytics, and then after that, had a product at Twitter post-acquisition. But the reason we're here today is way back in 2007, I had the opportunity to run Stanford University's Entrepreneurial Thought Leaders Seminar Series. And we invited amazing entrepreneurs, Mark Zuckerberg, Reid Hoffman, Vinod Khosla. And what I'm really
You guys have the famous video online, right, of Zuck?
We literally do.
Wow,
yes,
what
yes.
a great, everybody should watch that like once a year.
I completely agree.
Okay.
Marissa Mayer gave an incredible talk. It was just such a special moment in sort of the tech scene in Silicon Valley. And so what I'm really excited about with Between Two Founders is the opportunity to highlight today's generation of amazing founders and entrepreneurs. And so today, we have a legend with us, Aaron Levie. You've been the...
But you didn't invite me to the ETL event. Interesting. Very suspicious.
Well,
okay.
it's all worked out in the end.
All right, fine. Okay.
So Aaron's been the founder, CEO of Box for almost 20 years, from his dorm room through IPO and beyond. He's also one of the original pioneers of the cloud software movement, and I'm probably best known for your Twitter commentary, millions of followers, for better or worse.
That's too bad, yeah.
So please join me in welcoming Aaron Levie.
Thank you. Well, I'm glad that our PR team told you that you had to include that I helped create the cloud industry. This is great. So, very accurate.
We know the messaging we want to communicate.
Yeah, this is good.
Yeah.
Okay.
So what I wanted to start way back in the day.
Yeah.
So you dropped out of college.
Yes.
Why?
Well, there's two reasons. Basically, Box was starting to take off, and and in this context, take off in the sense of like we had, I don't know, probably like $100,000 in revenue or something like that. So for us, this was like, wow, this is actually happening. And then the second reason was I just hated college. So maybe if I was super good at college, like I would have kept going, but I mean, I love my friends in college, but like I was just a pretty bad student. And so that contributed to, kind of just always having a lot of frenetic energy around creating different ideas. Box happened to be, the one that ended up kind of taking off. We tried lots of other startup ideas, but it kind of got to a point where it was working well enough that my kind of ROI calculus was this would be just much more exciting, and I'd regret this more if I didn't pursue this this direction than staying in school. So my co-founder Dylan, we dropped out our junior year of college, moved to the Bay Area, and then we had two other friends drop out of their respective colleges as well, and that was kind of the founding team of Box.
So I want to take it back, because a lot of folks here are very early stage.
Yeah.
How did you come up with the original idea for Box? Like, what struck you?
Yeah. So again, lots of other ideas, and the reason why sometimes just like your idea can't just be bad, and so like we should just be totally honest about that. And I had many of those prior to Box, so Box was the first thing that kind of actually started to come together, but had done kind of random startup ideas for probably about five years or so. From high school to college, and tried a bunch of different startup things. Kind of everybody who was in college in like the mid 2000s would build like an online kind of service for like figuring out like the parties on campus and all the events. So I had one of those. You sort of just had to do that in that period of time as a requirement. I had a search engine that was like just like substantially worse than Google on every dimension. So that obviously didn't take off. A bunch of other ideas like that. And fortunately, I had a well-timed project in college to study a market. I was getting my undergrad in business and to study a market and identify like where there would be like an opportunity to basically, what were the opportunities of this particular market. And most people did things like shoes and restaurants, and I randomly chose. It wasn't obviously random, but like I don't exactly know why it all came together. But I chose this idea of online storage, and the idea was in the early 2000s, late 90s, there were a bunch of companies that had this pretty straightforward idea, which is once everybody moves to the internet, you'll store data online and then access it from your computer anywhere. So we clearly didn't invent the idea of putting information online. That had come out in the 90s. The problem was it was cost prohibitive. It was too slow. The internet was simply too slow back then, and we didn't have a lot of the modern application standards that we now obviously have, but didn't even have maybe 20 years ago. And so looked at this market, and it was this kind of really interesting moment, because the more I studied this, the more I was surprised that nobody had emerged in this time. At this point, it was 2004. That nobody had emerged in 2004 to solve this problem, which is like storage is way cheaper than it was 5 years ago. The internet's way faster than it was 5 years ago. Browsers are way better than they were 5 years ago. Why has nobody come and created a new internet service for storing data? So through that project, I was just like, oh my God, like, am I missing something? Like, why are there not a ton more people paying attention to this? So put together kind of initial prototype, kind of put the website online, went after lots of bloggers at the time that were writing about websites. This was before kind of TechCrunch and everything kind of emerged. And people just started signing up. Nothing kind of rapid. Most of the people like replacing their thumb drives, replacing FTP sites, emailing themselves files, moving those to our service instead. But it really felt like there was enough kind of momentum here. People were actually paying money. We only had a paid service, no free service at the time, and so people were signing up. My co-founder and I decided to dedicate our summer between our sophomore and junior year to this. And sometimes you just get dumb luck. So I had been trying to get an internship that summer at a few different companies, including Google and a couple others, and got rejected from all those. And if I had gotten those internships, like who knows, maybe the company would have died that summer. But basically, was sort of forced into this, and it just kind of kept taking off a little bit more. So we raised some funding that summer, and then through the fall, and then dropped out at the end of the fall.
That's awesome. And I want to talk about the funding for a second, because it was a very different world than it is today, particularly in this early stage pre-seed, seed world. Tell the story of your first money.
I still don't actually know what pre-seed is. So, so I'm figuring all this out. But basically, funding back then was like literally just, there were no names for things. Like you just literally were just trying to survive as a company. So we raised from anybody we could. There were 2 separate rounds that summer and early fall. And this is where everybody will, I think we're about to hear a gasp in a second. We raised $80,000 and sold a quarter of the company. And I've got a couple. Thank you for the gasp. And we were fucking pumped. Like we were like, we have made it.
Yep.
Like literally, I think this is how you become a billionaire. We were like so excited to get. It was, I think, 4 checks. It was these 4 angel investors in Seattle. We got 4 different checks for $20,000. Sold a quarter of the company. We were just like on cloud. We were flying. So that was pretty cool. We instantly all that money just like went directly into like Google AdWords. So like that disappeared overnight. So that kind of ran out of excitement. And we kept pitching different people, sending emails around. And then one that really clicked was Mark Cuban. We did a cold email to Mark Cuban and pitched him and his team a couple times, and then he wrote a check for, I don't remember the exact number, but plus or minus 300,000, plus or minus maybe 50K, So about kind of $300,000 from him. Also sold a quarter of the company.
Wow.
So we're just like really into selling a quarter of the company at a time, and for nominal amounts of money. The ending's kind of happy on our end. We actually bought back both sets of investors due to kind of the circumstances the business was in. Kind of wild situation. But so that dilution, unfortunately, didn't stick. Maybe unfortunately for the investors, they decided to sell. But yeah, so that kind of gave us enough momentum to decide to ultimately drop out. But the environment was totally different. There was not, I think YC maybe, I believe, started the summer that we were doing Box full time, and that was the first class of like Sam Altman and some other folks. So that maybe, in a parallel universe, if we had maybe, gotten lucky into that ecosystem, we would have had a slightly different fundraising experience. But for us, we were just, 2 people on computers in Seattle at the time for our summer break, just trying to raise from literally anybody. So we sent emails to everybody. This is just like this sounds like it has to be like not possibly real, but like I sent a literal fax to Bill Gates' fax machine. They didn't list his public phone number, obviously, but for some reason, like the fax machine was public of like the Bill Gates office. So we sent him a fax. He didn't respond, obviously, and so that didn't. And like also, why are we pitching like at the time like the chairman of Microsoft on doing an angel round? Bizarre. So like we would, but literally, if you were listed as like you had been in tech and you had any amount of money, I'd sent you an email, I'd sent you a fax. I printed out letter on Paul Allen's security gate doorman of our business prospectus. He also didn't respond, and so we were just trying to pitch everybody. And
I love it.
Mark was crazy enough to respond, and so were this kind of small group of Seattle angel investors.
That's fantastic. Well, so you started off more on the consumer side with these bloggers, the folks signing up, storing their files. Talk to me about the pivot to enterprise. How did that come about?
Yeah, so when we started the company, the original business plan was we didn't really think in terms of personas per se. We basically just said, okay, the internet should be able to let you store data. You should be able to get access to it from anywhere. And so by definition, this could, small businesses could use it, college students could use it, people could use it for their photos, whatever the use case was. This is sort of, it transcends, kind of the kind of type of user. And so we launched this. It got traction. We dropped out of college, moved to the Bay Area. We got super lucky. We were at a very early party at the founder of TechCrunch's house, Michael Arrington, and we ran into, and this is where our worlds kind of connect at some point, but we ran into this investor, Emily Melton, at DFJ. Mm-hmm. And I don't know what her role was at the time, if she was a partner or not a partner, or what associate, who knows. But she brought us into DFJ. And then we met Josh Stein at DFJ and pitched this idea of, hey, Box will be this, kind of easy to use product. We want to actually have a freemium version, so we want to let people just go adopt it on their own, and then they'll pay more money for it afterwards. And DFJ had made a lot of money on Hotmail. And I don't remember if it had exited yet or what the dynamics, so I forget all the specifics, but I think Skype. So they actually were like, if you were doing like freemium software like this, DFJ was super, super early on the whole freemium kind of train. So they invested, still business model independent a little bit, but Josh was also doing B2B investing. And so he kind of was getting in our ear about this idea of what if when people brought Box into an enterprise, you guys had like a version that you could sell to the enterprise.
Yep.
And he brought this up maybe half a dozen times. Wasn't something that I was paying too much attention to. We also had our 5th employee had been an intern at Sun Microsystems, so he kind of knew enterprise, and he was kind of starting to talk about this more. And so over about a 3-6 month period, we started to sort of eventually realize that we were being pulled in 2 different directions, where we had these consumer users that basically, every time we talked to them, wanted to spend less money on us. They wanted more features, but those features weren't particularly differentiated. They were like, we want like a backup, for our photos on our local computer. We want, again, very, very basic things, like technically quite easy, relatively undifferentiated, and you couldn't really command a lot of kind of pricing power for those. On the other hand, we had a lot of business users coming to us saying, well, if you had these security features and you plugged into my IT systems this way, I'll actually pay you thousands of dollars or tens of thousands of dollars. And so to us, eventually it became this pretty straightforward IQ test of just do you chase this commoditized thing, or do you go after something where you can be more differentiated, people will pay way more? Then you overlay, at the time there were these big rumors that Google was coming out with, it was called Platypus, and then they had a couple other names, and this was basically Google Drive. And so we were like, holy shit, basically you're gonna have Google, Microsoft, Facebook, Apple, others go and commoditize this category on the consumer side. On the enterprise side, you had these multi-billion-dollar kind of markets that were mostly in data centers, which was like your storage infrastructure, your document management software from legacy solutions. And we kind of got increasingly pumped up about this idea that what if we took the freemium business model and the consumer approach to product kind of execution, but use that as our kind of disruptive way into enterprises. And I was actually probably the most resistant of the founding team initially on this path, but eventually got compelled by this idea that maybe we could not lose our consumer ethos as we go enterprise. We do this low-end disruption thing and then sell an enterprise version. So it was about a 3 to 6 month period of pivoting in kind of early 07, late 06, 07 timeframe. And then we kind of did the burn the boats thing of we're just done even thinking about consumers. We're not going to talk about them. If any happen to join, that's totally fine. But we're going to do B2B, and that's going to be our business model.
Yep. And so now you're in this market, and you mentioned there's a bunch of big legacy players, huge amounts of budget funding in the space. You're still this pretty small startup. How do you think about going against these guys?
Yeah. So I started to get into Clayton Christensen at the time. Some of this is a little bit of me retelling what we were doing without kind of all of the frameworks from Clayton Christensen and others, but eventually got super into it, and kind of it's I live in if I have a religion, it is innovator's dilemma. That is my worldview on kind of 95% of capitalism is the world runs and lives and dies by innovator's dilemma. And eventually it became very clear to us that we had this sort of innovator's dilemma opportunity with the incumbents. The incumbents in our case, some of this is now pretty quite some time ago, so it's not as relevant to any company today. But the innovator's dilemma for a technology company in 06, 7, 8, 9, 10, let's say, building for the enterprise, the legacy players sold you, sort of packaged software that you ran yourself, that you had to hire millions of dollars worth of partners and system integrators to go install. You had to manage the data centers to actually, run the infrastructure. You built that all out yourself. You were responsible for all the uptime, everything. And their business model was to, again, keep shipping you new versions of this basically packaged software that you ran. And we, on the other hand, doing this cloud thing, we're effectively running a complete end-to-end service for them. And so we were compressing this entire stack of technology, the servers, the storage, the software, the network, the management, all of that. And that was a massive challenge for the traditional incumbents for a variety of reasons. One, the skill set was totally different. Two, their software was built in a single tenant way, which means you could really only run one enterprise at a time. We were multi-tenant, which means that we could have any number of customers, and you just kind of scale with that usage. Every time we built a feature, it goes live for everybody. Every time they built a feature, it goes live one at a time for the customers that update it. They didn't really know how to run kind of data center scale, kind of operations. So different DNA as companies, and then we could basically afford, because we were much smaller, to charge way less for this compressed version of that stack than what they could do. I mean, these were companies that had, at the time, maybe to generate $1 billion in revenue, and we only had to generate $10 million in revenue, so we could do much more disruptive things from a pricing standpoint. So the more we got into this, we realized like, well, we can just be better, cheaper, faster, simpler, and basically get ahead of the curve of all of these incumbents on mobile and integrating with all the customers' other software and ride this whole kind of SaaS cloud wave in a way that the incumbent couldn't. And so we just exploited every dimension of that. And to this day, my general advice for any kind of founder is always to find the situations where you have an asymmetric advantage versus your competition. And if you don't have an asymmetric advantage, probably any competent competition will eventually copy you because they obviously care about survival. They're not like there's no incumbents at this point that are as sort of ill-informed or idiotic as maybe they were 25 years ago. They don't exist. Yep. So you have incumbent companies that are incredibly competent, very savvy. So you always have to find what are your asymmetries. What are the things that you can do that it's not that your incumbent doesn't want to do. That's not enough. What are the things that they literally can't do? Their business model doesn't allow it. Their talent profile doesn't allow it. Their earnings to Wall Street doesn't allow it. You have to find those things. They were plentiful in our era, and so we got to exploit all those.
Awesome. So I want to shift gears to M&A. You hinted at this. Our stories do overlap, intersect 15 years ago. So my first company I started in 2007 was called Increo, document collaboration software. We ended up raising money from DFJ. We got to know Aaron and Dylan. And in 2009, we were acquired by Box as the first M&A deal I believe you ever did.
Yep.
And so what did you learn from that? What's your approach been to M&A? How have you thought about it since then?
Yeah, I mean, it was a very critical deal for us. Jeff and Kimber basically as far as I can tell, invented being able to render documents in a web browser across formats and super seamlessly. And we really needed that technology because our whole job was to render documents. So
at the time in Box, you could upload the file and then you would click and download the file.
Yes. These are like very esoteric jokes for people. So so in the land of documents, the kind of stuff we talk about, this is like some pretty cool stuff. And it also just shows the age of a pre-seed founder that nobody realizes why this is such a big deal. So back in the day, working with documents on the internet was a very painful experience. And everyone has gotten so used to PDF.js, and like nobody realizes just like what it was like when you just could not preview something in a browser. So Jeff and Kimber had this amazing technology. We were super fortunate that DFJ kind of had invested in both of us, and so saw the possible combination. And basically, we incorporated the technology and used it for a number of years. From an M&A standpoint, so we've done, I don't know the exact number, maybe 20 or so acquisitions, and to some extent, I think the template actually was sort of defined without us knowing it by the Increo acquisition, which is we always look for essentially fantastic technology and then fantastic kind of founding teams and engineers in particular around that technology, and we've never done a deal that doesn't have that combination. Now, just to show that why that's different than like of all the portfolio things, we don't really look for like what's the biggest company, what company has the most revenue that we can acquire, what company has the most number of people that we can bring on. We really, really care about our platform and the sanctity of our platform. So we want things that let us accelerate our product roadmap that can be pulled into the platform technology relatively quickly, and things that give us a kind of superior technical advantage for as long as possible. So all of our acquisitions, again, kind of almost look like offshoots of that original Increo acquisition, which is critical intellectual property that we think is just profoundly important to our strategy, and then a great team that we can bring in that will actually kind of see that come to life. And we've been really fortunate to do that now a number of times. We have got lots of people in the company now running around that were the CEOs of those companies or early founders of those companies, and it's been a great experience for us. Maybe the lesson for any startup out there is to always just keep the quality bar incredibly high, not only of what you build, but of the team that you have. That just gives you the most amount of outcomes. I totally think you should never think about being acquired. Like every company needs to have a path for survival without M&A ever being a factor. But as a backup plan, or that one day when it just might kind of the stars might align, it's really important to have a company that works in an M&A environment as well. And so keeping the bar very high on that can be very important.
Totally, could not agree more. And so as part of this M&A strategy, you recently bought a company called Alpha Moon, I think some AI technology. How have you seen AI impact your business? What's your view of AI in enterprise?
Yeah, so how many folks are enterprise, doing enterprise stuff? B2B, okay, and how many on consumer? Okay, and so I'm very biased to the enterprise side. I think enterprise will be where we see the highest kind of amount of impact from AI specifically, simply because the amount of automation that enterprises have yet really both need, and the amount of things we have to automate are just enormous. And so I think most enterprises are always looking for ways to be more efficient. That efficiency can be more clearly measured in an enterprise context than it can in a consumer context. So you just have this natural market where people want efficiency. They'll pay for it. They can measure it, and they want, like, there's a natural economic incentive for them to do that. Versus again in our personal lives, we don't really know how to quantify efficiency, so it's not as compelling. So you don't get the full breadth of AI use cases on the consumer side. So I'm massive believer in AI in the enterprise. For us, it's kind of exactly what you'd imagine, which is what if you could unlock all the value of your enterprise data? What's inside of that information that would make your business run better, help you make better decisions, help you automate more workflows. Alpha Moon is one more piece in that technology. It does this kind of capability of intelligent document processing. So you give it a contract, it tells you what's in the contract. You give it an invoice, it tells you what's in the invoice. As you can imagine, that's incredibly important to our strategy. So again, classic team, amazing technology being plugged into the platform, and we continue to pursue those types of opportunities.
Awesome. Let me say, so we have a few more questions. We'll open it up to the audience, so please submit via the QR code. We'll go through some audience questions as well. But I want to shift gears and talk about leadership. So you've now obviously been with Box a long time. Company's gone from very small to very large. How has your leadership style evolved over that time? Has it? Are you the same person you were? How do you see that?
Yeah, I think I'm the same person. It's always this interesting thing where I think people, I look at people that have scaled, let's say, 10 times more than how much we've scaled, and I assume, like, wow, you must have had to have changed or something. And then I look at myself and I look back and what's interesting is that, like, the kind of core premise of the job today and the job at, let's say, 4 employees is not, like, radically different. We are going to live and die by how good is our product, like how good is our go-to-market in getting that product to customers, how good are we at serving customers from a customer success standpoint, how quickly can we pivot on ideas and iterate. So if you think about the job of a founder or a CEO is basically make sure your company survives or thrives. The only ways you can do that, given that we're all in product businesses, is to build an amazing product. And the only ways you can do that is like innovating quickly, getting customer feedback, iterating, like all of those things.
Yep.
So if I think about my day to day, yes, there's more constituents that I have to think about. We do more IR and Wall Street, kind of engagement. There's more analysts that we have to talk to. Certainly more customers that I can spend time with. But like the things that will that will drive whether we live or die as a company are not all that dissimilar from what they were in the earliest stages of the company. So then that means by definition I channel my time into those exact same things.
Yep.
Are we building the right thing? Is it designed the right way? Is our roadmap the right roadmap? Are we shipping features as quickly as we can? Are people working as many hours per week as they should be? So that's sort of the that is always in the back of my head about how do we drive execution across the company. So there's not that much that has changed. In enterprise software, maybe one change, like I have to do more like steak dinners than I did 15 years ago. And for those of you in enterprise, you're going to be doing this. You're going to go to name your state, and you're going to host a dinner with CIOs, and you're going to talk about their IT, strategy. So you do that a bit more.
Yep.
Other than that, and maybe some Wall Street stuff, my calendar looks pretty similar. The kind of content in my head looks pretty similar, and that's what makes it fun. If it changed dramatically, I wouldn't want to do it. And I think that maybe the one interesting thing for those that haven't been in it in the same way, especially sometimes your VCs, sometimes other folks like they can almost kind of can almost accidentally sometimes convince you that there is this thing that you're supposed to be doing.
Yep.
And and I almost had this existential crisis 3 years into the company, which is wow, all these other CEOs, they seem to look like this, or they have this kind of thing that they've focused on or done. And to some extent that was just because this was pre the era of founders that were more product centric. Yep. And then we kind of had that wave, and we realized, no, actually, that's just another archetype that you can be. But really, your main job, maybe if I add one more, kind of key aspect to survival and scaling as a company as a founder, is your main job is to make sure you have a team that is perfectly, kind of aligned and coordinated and can, complement each other's skills in a way that lets you execute. So as long as you can build that team, yep, what you personally do in your role in that team can be variable by the person. So for me, it's product, but there's plenty of people that it won't be product, it'll be some other kind of thing. But the key is just, can you have a team that does all the other stuff? And I think we oftentimes, early in a company, are well, maybe I'm not the right kind of CEO or all these kind of things. And it's that's the wrong way to think about it. Do you have a team that can you hold on to, can you build, can you organize a team that lets you have all those functions? And then can you lean into the areas where you have the greatest strength? And that's I think maybe the thing I've learned as we've scaled up.
That's awesome. So, I mean, you famously have extreme energy. I remember this vividly. We'd be in the office at 9, 10 p.m. bouncing ideas around. This was before either of us had kids. How do you balance that relentless commitment with building a sustainable culture that allows the company to grow and last for 20 years?
For me personally or other people?
I think both, because that's important.
Is it? Okay. For me personally, I think that the good thing is that again, if you're in a founder role, if you're doing things right and the company's working, to be clear, you should be able to, channel your energy into the areas where simultaneously you can have the most impact, but also you get the most fulfillment from. Mm-hmm. And so again, because I have the opportunity to build a team that complements and supplements all the things that I'm good or not at, that almost by definition allows me then to go and do the things that I'm going to be both most fulfilled by, but the areas that I probably have the best ability to impact. That just automatically then creates my energy, because it means I get to work on, whatever the next breakthrough product is, or what new areas of innovation, do we have happening on the technology side. That's kind of what energizes me. If my calendar were totally different, I'd probably get burned out in 3 months and not want to do it. But I've been able to again ensure that I get to channel my energy into things that are most exciting. For everybody else in the company, I think it's mostly about can you build a culture that tries to find the intersection of maximum output and execution without sort of going over whatever the threshold is where you get negative productivity because you're dealing with people that are doing sloppy work, or where the attrition is so high that you can't retain the kind of critical tribal knowledge, or where it's just not enjoyable to work with everybody because everybody's just so sort of stressed out or whatnot. And so finding that whatever that optimal point is always the goal. Sometimes you kind of miscalibrate or you don't quite get there, but that's kind of what I'm always trying to achieve.
That's awesome. We have a great question from the audience. How did you think about your first 1 or 2 go-to-market hires, sales? How did you build that?
Yeah.
What lessons did you learn?
Yeah, so we got really lucky on this one, and it has forced me to kind of go against the current a little bit on typical advice, but I do recognize that I'm afforded this because of our first sales hire. The typical founder advice is like you're the head of sales for a long time, and you're the one closing the deals and whatnot. And I've been able to give advice that looks different from that, which is actually you can actually get a really good head of sales that will let you get 10 times more kind of impact for your time instead of just being in sales calls all the time. This worked for us because our first head of sales that this guy Jim Herbold happened to be this kind of interesting type of sales leader where there's a really great PDF called the Enterprise Sales Learning Curve, and it was from an enterprise software executive, CEO from the 90s, that basically wrote about this concept of having this kind of renaissance sales leader that kind of like knows enough about product that they don't like, that they can go into a customer meeting, figure out what are the feature gaps, take that back to the product team, all of this, instead of maybe your typical caricature of a salesperson would not be to have that happen. So we lucked out. I can't tell you how we purposely landed on this person, but we did. And if you can get one of these kind of renaissance-y enterprise sales managers or leaders, then that affords you the ability to have way more augmented capacity from a go-to-market standpoint, because it meant that we could do 10 times the number of sales calls than if I was responsible for it. I could be on a couple, but I could mostly get the feature output of like, okay, they need this, they need that, which ones should we build, how should we put it together? So I could spend my time on at least what I perceive to be much higher leverage things as opposed to one-by-one sales pitches. And that worked actually. And so that sales leader got us he scaled to 100 million in revenue, awesome. Which is, I recognize that it's hard to have that happen, but if you can get the right person and they then hire the right people below them, it is possible to actually scale up. Everyone has this, kind of, typical wisdom of like your first sales leader is not going to work, but it can happen the other way.
So for so many people here, you start the company, you have this dream, you want to build this huge thing, and you're like, one day we'll be public.
Yeah.
You actually went public.
Yeah.
Was that a good idea? Well, like what happened?
Yeah. Well, for us, it was definitely not a part of the vision of the company. I think eventually we got maybe excited by the curiosity of it, but it was not like something that we established as a core goal. And I was the most nervous about it. Dylan, my co-founder and our CFO, kind of to him it was just like obviously we're going to be public and we're going to go through that. And I kind of kicked and screamed a little bit, just because I wanted to see if we could grow a bit more privately, whatnot. But ultimately, on the other end of it, now many years later, with the caveat that like you should have a certain revenue scale just to make sure you have durability of the business model. And I highly recommend really thinking about being cash flow positive as opposed to burning cash as a public company. Those aside, being public can be a very strong positive. It keeps your business kind of running like clockwork. When you're a private company, we often have to sort of kind of create this channel energy about like, the quarter's going to end, and we have to hit this target. But you kind of know the consequence of hitting it or not is maybe your VC will get mad or you'll have to send some email update. The consequence as a public company is every single employee is going to instantly feel it.
Yep.
Right, in the stock price. And so everybody knows that like it is do or die every single quarter on whatever those results are going to be, good or bad. So you automatically have this rhythm in the business that can be helpful. I think it up levels sort of the need for corporate governance, which I generally see as a positive thing because that creates guardrails in the company that I think can be very positive. And again, it just forces you to deal with problems faster. You just can't let things fester, particularly long as a public company. You saw it in things like, let's say, Meta, where Zuck woke up one day and just be like, shit, these areas of investment are not working. We've gotten bloated and inefficient, and we could be way more profitable. And boom, he's added about $1 trillion of market cap in 2 years. Would that kind of change and execution have happened, not as a public company? It would be hard to imagine that. So I think it does sort of force you to be on the clock. and drive a certain level of intensity that can be distributed across the organization as well.
That's awesome. That's so well said. Another great audience question. Cloud storage, I'd now say, is a relatively mature market. How do you keep the excitement and new ideas? Have you considered like an adjacent business line? How do you think about that?
Yeah, so fortunately, if you just look at our revenue, kind of whatever we would call cloud storage has been a minority of our revenue for probably 10 years. So I mean, we were afraid of being commoditized in that category within the first 2 years of our existence. So, the first year was fun because we owned the market ourselves. Nobody else existed. But then all of a sudden, Google Drive showed up, a few other products. So we kind of quickly realized that the game for us was basically all the things you do with your data, not the storage of the data. And so that's workflow, that's data security, that's a bunch of these sort of business process use cases that companies do with content at scale. So just to give you some examples, like if you're a bank and you need to onboard your clients to your bank, there's a lot of documents that you sort of have to manage and collect. We will be the back-end platform that powers that for a number of banks. If you are a life sciences company that works with the FDA and you have to work on all of your audit practices of GXP compliance, we power a lot of those workflows for leading life sciences companies. So the kinds of things that are more about the business process and what you do with your content and your data, that's essentially where 98% of our engineering time goes into.
Yep, awesome. So for all the founders here, you've now met tons of founders over the years. You've had your experience and your co-founders' experiences. What aspects do you think make for a great entrepreneur who can build this type of enduring business?
I think you just have to be incredibly excited about what you're doing. And there's nothing that replaces just the raw, kind of energy of are you literally happy about what you're doing? A few factors that over the years I've realized, are important variables for me. Working on problems that you care about, obviously. So like, don't start a company because it's just this sort of temporary fad that like looks good in the news right now, and then you're just jumping on some trend because it's more likely than not that 2 years down the road, when that's not a trend and there's no hype around it, are you still going to want to be pursuing whatever that thing is? So like you should definitely assume that the excitement around whatever you're doing is a temporary kind of thing, and this is just going to be like as boring as possible in a couple of years. And will that still be exciting for you? So like, and we've seen eras like this in the late 2000s, early 2010s. You'd have these periods that pop up. Everybody remembers Groupon probably, but there were like 30 Groupon copycats, and you kind of ask yourself like, why would you create a Groupon copycat? Like nobody like got out of bed one day and was like, I'm just so pumped to do sort of like temporary coupons to local restaurants. Like that was nobody, like very few people, like that was their life passion. But yet we saw like hundreds of those types of things. But obviously, they all went out of business. Yep. Maybe somebody learned something for a couple of years, and so I don't fault anybody for the experience. But like, you're clearly not building an enduring business. And so I'd step back and be like, are you doing something because it's like like there's a news hype cycle around it right now, or are you really excited about what you're building? Could it outlast once there's this kind of wave of momentum? That's critical, number one. To be fair, I didn't necessarily know that about what we were doing when we started the company, because I was, we were sophomores in college. I probably would have done anything. So I can afford to say this because I ended up finding that actually I really love what we do. But now with that benefit, I would say try and think about that a little bit. There was certainly no hype around what we were doing when we started Box. So we were going after a problem that we were passionate about. Second is the people that you're surrounded by, and I've found that one of the most enduring things about how we built the company is that I really like the people that I get to work with. I learn a ton from them. I find it fun to be in brainstorm sessions and collaborate with them. If I didn't like the people I worked with, it wouldn't work. And so 19 plus years into the company, these are the kind of things that I get me excited, and working on hard problems, working with great people, and just continuing to kind of scale up.
Awesome. Fantastic. We need to end on a wild card.
Okay.
You've had this career path. What do you want the title of your biography to be?
I don't want a biography, so I'll be all good. Good to see you all. Good luck on your pre-seed startup, and just get lots of customers. Yeah, good luck.
Awesome. Thank you, everyone.
Thank you. See ya.
Okay. Thanks. All right.
All right, folks. Wow. Jeez. Did you guys have fun? That was the, obviously, I've been at all the 7 pre-seed summits. This one was by far my favorite. I feel like the combination and the balance of humor and insights was just bar none. We were cracking up in the green room in the back, especially when Freddie was going on and bashing pre-seed or whatever he was doing. Anyway, it was a lot of fun. So once again, thank you guys for being here. I also want to give a round of applause to the Afore team for putting this together. I don't know if anybody's... And then now we're going to break for happy hours, which is just outside. There should be drinks and hors d'oeuvres. And once again, just a quick plug for Afore. If you or anybody you know is starting a company, please reach out to us. We're pretty easy to find. Just first name at afore.vc. Once again, thank you very much. We'll see you next year. Bye.